a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
It's 9 a.m. here in New York City. I'm Brad Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco.
Well, stock futures are rising this morning as the S&P 500 and the Nasdaq notched yet another record close. Investors are increasingly optimistic that the Fed is going to start cutting rates soon, and they're looking for further evidence inflation is moderating in Thursday's key CPI report. So let's get right to it. The three things that you need to know this morning. Yahoo Finance's Jared Blickery, Rick Newman, and Pras Subramanian have more.
Stock futures are higher after the S&P 500 rallied to yet another record close, notching its longest win streak in 5 months. We're also watching Treasury yields rise ahead of fresh reads on inflation, CPI and PPI out Thursday and Friday. All of this comes as Fed Chair Jerome Powell heads to Capitol Hill for his semiannual monetary policy address. The testimony will take place Tuesday and Wednesday before the U.S. Senate Committee on Banking, Housing and Urban Affairs and the U.S. House Financial Services Committee. Powell will face pressure from lawmakers around the Fed's timing of rate cuts and possibly questions surrounding banking regulations.
President Biden is kicking off a 3-day NATO summit in Washington, D.C. today as he faces growing scrutiny over his ability to serve as president for another 4 years. Biden will make a welcome speech this evening, attend meetings with foreign leaders, host a dinner at the White House, and wrap up the event on Thursday with a press conference with reporters. Biden's performance will be closely watched after his weak showing in the first presidential debate caused a number of Democrats to call for him to drop out of the race.
And Tesla shares are on a tear, the stock notching 9 days of gains, erasing year-to-date losses. The rally comes on the heels of the EV maker's deliveries beat last week, and Tesla bulls are highlighting the company's fastest-growing segment, its energy storage business. Tesla slumped in the first half of the year amid tough competition and waning demand for EVs in the U.S. The stock is now up just under 2% for the year.
Markets eyeing another record high today. The S&P 500 notching its best 5-day winning streak since January. Now, this coming ahead of Fed Chair Jay Powell's address to Congress today. So let's talk about what exactly this means for the market. For that, we want to bring in Liz Ann Saunders, Charles Schwab's chief investment strategist. Liz Ann, it's great to see you. So when we've been having these conversations over the past several weeks now, the conversation has really been dominated by the fact that it's largely driven the gains we've seen by these handful of large cap names. There's some worry about the lack of breadth that we're seeing in the market. I'm curious just your broad take of the current setup right now and how this looks here in the second half of the year.
Yeah, so it's a tale of two markets, and that's one of the descriptors we've been using to describe this backdrop. If you're only looking at the index level, you've seen a rip higher, you've seen all-time highs, 35 of them this year, but under the surface is a much different picture. There's a lot more churn and rotation, weakness, turmoil to some degree, and it's really heightened in the Nasdaq. The Nasdaq is at all-time highs. It's had no more than a 7% drawdown at the index level year to date, but the average member within the Nasdaq has had a 39% drawdown. So that just tells you that just looking at the index level doesn't tell the full story. Now, on the other side of that, it also means opportunities have been created with a lot of that weakness and churn and rotational corrections under the surface. So I think there are opportunities, and it wouldn't surprise me if we see some convergence start to happen where maybe you see some profit taking up the cap spectrum into the mega cap names, but some interest on the buy side in some of those other areas.
What is the the biggest event driver, even in this tale of two markets, as we're looking at this second half? Is it the Fed cut? Is it geopolitical concerns? Is it election risks?
I think those are all important at a broad macro level and affecting things like volatility, not really at the index level, because a measure like the VIX is not even, a teenager at this point, but at the individual stock level. But in terms of defining within the rest of the market, the performance spread between the winners and the losers, you can do that at the factor level. And there is still a quality bias in terms of what's working and what's not. You can do a profitability range, and that's particularly acute within the Russell 2000, where the profitable stocks have done quite well over the past year. The not profitable stocks have done quite poorly. You can look at it in terms of interest coverage. High interest coverage stocks have done very well. Low interest coverage stocks have not. Strong balance sheet companies versus weak balance sheet companies, big performance spread there. So I think that's how to think about the market, but also navigate where there are opportunities and where there are landmines. I think the best way to do that is actually at the factor level or characteristic level, as opposed to, say, at the style level or at the sector level.
Then when you talk about the fact that we are seeing this wide gap between the performance of some of these handful of large cap names versus everything else that's really underneath the surface, is this a trend that you see could potentially persist for some time?
It could, and I think it's a fool's errand to, if you hold a lot of the big winners, to try to figure out, okay, at some point there will be consolidation. When does that start? It's why we always point to the really beautiful discipline that is rebalancing. It forces investors to do a version of what we know we're supposed to, which is buy low, sell high, but in this case, add low, trim high. And here's though where psychology comes in. Very recently, I had a conversation with a client about one particular stock within the Magnificent Seven, and this client had sold a little bit of the position, and then the stock ripped higher. And this client said, "Oh, I'm so mad at myself. I'm so annoyed." Meanwhile, they still have a huge position, and the stock has gone up a lot. But it's the psychology of, but I sold a little bit, so I posed the question back: would you be happier if the stock went down a lot? Because then you had the bragging rights of, well, I trimmed a little. So this is where psychology comes into play, and rebalancing just means you take some profits and you find opportunities to add where there's maybe been underperformance. And that's how we're suggesting you navigate this environment, because when the party ends, I don't have any great, clearer crystal ball than anybody else does on that note.
Mine is in the shop too, Liz Ann, so that is fair. One of the massive things that we think about is what you were just mentioning is if you are kind of rotating out of some of those positions or at least trimming on some of those positions that have outperformed, where there are viable opportunities that the market may not be fully pricing in a rebound on right now, and where are those opportunities from your perspective? Yeah,
so again, we have had more of a factor-based focus than a sector-based focus. So the factors that we have been emphasizing definitely fit within the quality umbrella. But I think in particular now, in addition to traditional quality factors like strength of balance sheet, strong free cash flow, high return on equity, profitability-based factors, I think you also want to take kind of a GARP-like approach, to use an acronym from years ago in popularity, growth at a reasonable price. So you want the profitability and growth characteristics, but not sacrificing valuation. But that's definitely still a quality wrapper around where we think there's opportunities. And also the other thing that people forget, there's so much focus on whether it's the largest 10 stocks or the Magnificent Seven, and let's use the Magnificent Seven as an example. They're the biggest contributors to S&P returns, to Nasdaq returns, because of the multiplier of their huge caps. But a lot of people don't realize, in the case of the S&P, the top 10 best performers within the S&P this year, only one of them, NVIDIA, is in the Magnificent Seven, and it's not the best performer. 3 of the top 10 stocks are actually utilities. One of them, believe it or not, is GE, kind of old school. Within the Nasdaq, the 10 best performers, there's none of the Magnificent Seven in them. And not only are none of them household names, I've never heard of any of the top 10 stocks. So it's the multiplier of cap that makes them the huge performance contributors. But I think people conflate that and think they're the best performers within these indexes, and they're actually not.
That's a great point there, Lizanne. We have to leave it there. Wish we had more time. Look forward to having you back soon. Lizanne Saunders, Charles Schwab's Chief Investment Strategist. Thanks so much.
Thanks.
President Biden kicking off his hosting duties today for a 3-day summit to mark the 75th anniversary of NATO's founding. Now, the event will be filled with remarks from foreign leaders and meetings addressing a range of global issues. And President Biden's performance will be closely watched after a weak showing at the first presidential debate prompted calls for him to exit the 2024 race. Here with more is Yahoo Finance's Rick Newman. Rick, no shortage of a list of topics to discuss here today, but let's start with the NATO summit since it is kicking off down in D.C. today. I guess my question to you is, does President Biden need to prove something to these foreign leaders over the next 3 days just about whether or not he is fit for the job?
I'd say he has something to prove to American voters more than he has to prove to foreign leaders. Starting with, can he remember everybody's name? We know what's going on here. Increasingly public questions about whether President Biden is fit for the job after that terrible performance on June 27th in the debate against Donald Trump. Some of this is going to be behind closed doors, and we're not going to know exactly how Biden comports himself. But he is going to hold a press conference on Thursday. Biden has not done very many press conferences, and his administration is now under pretty heavy fire for accusations that they've kind of been hiding Biden's aging by not putting him out in these types of public events very much. So what I think is going to happen is Biden is going to have to get out and really show that he can handle the heat, and that's going to be part of the subtext here. I would add, this is an important meeting. This is not just a ceremonial meeting because it's a 75th anniversary of NATO. Really important because of what's going on in Ukraine. Let's not lose sight of the fact that there is a huge war still going on in Eastern Europe, and I would like to point out that that $61 billion that President Biden had such a hard time getting Congress to appropriate for additional weapons for Ukraine has made a huge difference in this war. The narrative of this war has really changed during the last couple of months. Russia was making advances because Ukraine just didn't have the weapons and to some extent the manpower. They now have the weapons, and they have stopped Russia. And there's new analysis suggesting that Russia is just stuck. It may never be able to get out of the quagmire it's in. And for what it's worth, the Russian army sinking into the quicksand in eastern Ukraine, that is in America's interest. So that is something that NATO, is going to be talking about. And to some extent, that is a success. But obviously, there's a lot more to do on that.
Rick, and we know that that's going to be a key focus for a lot of people who are tracking Biden's performance and his messaging. But a lot of other people, those who he's fundraised with over the past years. Talk to us a bit about Biden's fundraising efforts. The campaign says it has $240 million cash on hand. We're seeing some reports that fundraising has gotten harder since the debate.
Yeah, it's a mixed bag. And we have to point out here that we only know what's happening with fundraising in real time when the campaigns tell us what's going on. For the real data, that there's a lag in that data. Biden has continued to pull in what we would call small dollar donations. These are normal people. They're not giving $10 million to a super PAC. They're giving, it could be $20, $50, $200. The limit for the campaign donations is $3,300. My colleague Ben Werschel has a story out today looking at the CEOs of the top 100 companies in the Fortune 500. He has found that going through all the campaign donation records at the FEC, that big CEOs of the biggest companies in the United States are giving a lot less money to candidates and to super PACs than they did in the past, which indicates kind of what we see among the public, that CEOs of the biggest companies kind of want to sit this one out, at least at the presidential level. They may not really want to be associated with either candidate or either cause at this point. They are still donating a lot of money to congressional candidates because they want to keep their influence there. But they're getting turned off a little bit from presidential politics, just like most of the rest of us, I guess you could say.
Yes, indeed, Rick. All right. Rick, thanks so much for keeping tabs on all
Hey,
of
guys.
this. We'll check back in a little bit later on. And we'll also have more coverage of the NATO summit in Catalysts. We'll speak to Jim Townsend, who is the former Deputy Assistant Secretary of Defense for European and NATO policy. That's at 10:10 a.m. Eastern Time. You don't want to miss it. Well, switching gears here, another story that we're watching for you this morning. Shares of TSLA, they're on the move right now as the EV maker taking a breather after notching its 9th straight day of gains on Monday. The stock's winning streak has erased its year-to-date losses. Shares have risen more than 75% since hitting its most recent low. That was in late April. Here to weigh in is Yahoo Finance's senior autos reporter, Pras Subramanian. Hey, Pras.
Hey, so yeah, Brad, so basically, we've been seeing the stock kind of rise meteorically since Elon Musk's pay package got approved in June, and sort of just been on a roll since then. We talk about they had a pretty good delivery number coming out over the right after the holiday, right before the holiday weekend, better than expected. Still down year over year, but still better than expected. There's some buzz about energy storage business doing well. There's talk about China doing better. They were able to sort of get a contract signed where they can actually sell Teslas to state vehicles to use for the government. So that's kind of a big deal for them. But it's one of these things where we always see the stock kind of have a boom bust cycle, right? And right now we're 2 weeks from today into earnings. And that's going to be a big kind of sort of moment for the company. And usually earnings haven't been good. They haven't been good for the stock, but they were good last quarter because of the fact that they mentioned that they're going to introduce some cheaper vehicles in the future. So that's sort of the bigger game plan here, along with robotaxis, things like that.
Yeah, Bruce, I guess my question to you is, how much do you think investors are focusing? It seems like investors still tend to focus on those more lofty goals and what Musk lays out versus what is happening today. Because when it comes to the fact that profit margins remain under pressure, EV demand simply is not what it was initially expected to be at this point, how much of that do you think is going to be reflected in this report that we're going to get in a couple weeks?
Well, interestingly, second quarter sales or deliveries were not that bad. So it kind of hints that maybe there was actually some demand recovery there. I mean, there were a lot of price cuts in the U.S. too, and potentially China's not as bad as people thought. So maybe there's going to be some upside surprise there, and we get more color on, is demand returning ever so slightly? We're seeing other brands doing a little bit better too, Ford in particular, some of Porsche and Mercedes also on that luxury kind of high end there. But the big question is, you're right, how much growth are we going to see in the future? I mean, can you hit that sort of 1.4, 1.5 sort of average growth rate, right, for the year? That's kind of under threat. And the question is, are the big bets going to overtake that?
Right. We got to go. But is there a lever that they could pull this quarter? You talked about what they said last quarter and talking about the future of vehicles that they're going to be unveiling or uncloaking. I mean, is there another type of lever that we could see them try to tap into here that would have the same effect and at least buoy some investor confidence for this interim period?
I think one of the things people want to hear with regards to the robotaxi reveal in August, are they going to be doing actual trials like Cruise and Waymo are doing? Are you going to have like fenced-in, geofenced-in trials of the car actually kind of being worked, like actually used in service? Right. For instance, are we going to have a Model Y with its current system kind of running around somewhere picking people up? I think that's sort of the question. It might get a hint on that. That could be a big, like I said, lever to pull. Like, oh, actually, we're doing these trials now. But in terms of new products, we're not going to see that for a while, and maybe we'll get some updates here and there. But it's not from a new product point of view. I don't see anything happening, at least not for the next year or so.
Interesting. All right, Pras, thanks so much. Tracking all things TSLA plus the mobility space as a whole. Appreciate it. Everyone, we're just getting started on the morning brief. Coming up, NVIDIA bulls are charging. KeyBank, the latest broker to raise its price target on the chip maker. We've got some top trending tickers next. Plus, Tesla shares dipped lower after notching its 9th straight day of gains, as we were just discussing. We'll see if the rally can last as we get to the opening bell and through it. And later, all eyes on Fed Chair Jerome Powell here, as Powell will be appearing before the Senate Banking Committee. That's at 10 a.m. Eastern Time. What this means for the markets later on in the show. All this and much more. You're watching Yahoo Finance.
It's time for some trending tickers. First up, we've got BP. Shares are off just around 4.5% this morning. Now, the oil and gas producer expecting weak margins in its refining business, and they're saying that that is going to dent their second quarter profit by up to $700 million. When you take a look at this release, some of the expectations, how they have shifted. They also mentioned that they're expecting a $1 to $2 billion write-down of a plant in Germany. The results from oil and trading are expected to be weak. So as a result here, they're also planning to scale back their refining operations in the country of Germany due to higher costs and declining demand for fuel. So this all sets up for what could be a maybe weaker than expected quarter for BP.
Yeah, exactly. And this is really pointing back to their customers and product segment as well. Customers, stronger fuel margins and convenience performance and seasonally higher volumes. So that's one of the factors impacting that segment. And then on the products, significantly lower realized refining margins as you were expecting, that $500 million to $0.7 billion impact adversely, unfortunately, and mainly relating to weaker middle distillate margins and narrower North American heavy crude oil differentials, and then a higher level of turnaround activity they're talking about as well. It was actually more interesting as well in the gas and low carbon energy segment for those who have those hats at home, who are ultimately tracking what they're expecting this adverse ultimate impact of about $0.1 billion, including declines in non-Henry Hub natural gas marker prices here. So all of this anticipated here impacting shares of BP, and it kind of signals and is in alignment, as you were mentioning, with what we had heard from Exxon coming into this.
Yeah, we're also seeing some analysts lower their expectations on the heels of this update. You've got Citi saying that they're now lowering their Q2 earnings, or EPS estimate, by 9%. Jefferies also adjusting their expectations. They now think that it's going to result in a 20% earnings downgrade there. So some figures to keep in mind ahead of this report.
Absolutely. The full report's going to be published on July 30th. So we'll be staying tuned for the rest of the financials in tandem with this. We're also watching semis this morning, semiconductors. Analysts over at KeyBank, they boosted their price target on chip maker NVIDIA from $130 to $180 over robust demand for its AI chips. The firm also upped its price target on Micron from $160 to $165 here. It was really kind of a sweeping analysis of the broader chip segment here, but kind of coming back to what they were using as their methodology, talking about this cloud instance tracker and how they use this as essentially data analytics, tracking the proliferation of semiconductor architectures by region based on instances available to purchase in the public cloud. All that said, they looked across AMD, NVIDIA, Google, Amazon, and others as well here, trying to get some clues with correlation to how much these companies are spending and when within their various architectures it will actually pay fruits for their business too.
Yeah, exactly. I think this all just comes down to demand, and they lay it out pretty just point blank in this report, saying that the AI demand continues unabated, that traditional server demand is actually improving. You mentioned some of those larger cap tech names there. The fact that the server supply chain feedback indicates that demand for traditional server demand continues to improve. Most of that demand is from those U.S. cloud providers that Brad was just mentioning, but they also go on to say that they are also seeing sustained demand from China, also moderating, improving demand here within enterprise. So all set up here for a bullish couple of quarters ahead of what potentially could be here for NVIDIA. When you take a look at the stock, yes, we have seen maybe a bit of a reset maybe in Wall Street expectations, or exactly what current valuations are after that 10-for-1 stock split. But again, the chart just says it all. Year to date, we're still looking at gains of nearly 160%. Yeah. And when you take a look at this momentum, it's pretty much consensus on the street that a lot of this is not going to slow down anytime soon.
Yeah, slight ding after. Right. And so the thesis largely remaining intact. A slight ding because of some of the insider selling that took place, but more largely the trend remains, and especially with what KeyBank is talking about here within the demand profile here, not seeing any signs of a demand pause as demand for H100 remains robust, they say.
All right, let's take a look at shares of Novo Nordisk. They are falling this morning after a new study found that Eli Lilly's Mounjaro has seen faster and greater weight loss results. Here are the takeaways. Our very own Anjali Kamlani. Anj.
You guys are going to hate this. It's such a nuanced report.
No.
It's such a nuanced report. But yes, the final result is not surprising. We did already know, based on the phase 3 trials from both these companies, that both Eli Lilly's drugs did have better weight loss results than Novo's. Now, we looked at the study looked at semaglutide, which is Novo's drugs, for Ozempic and Wegovy, and tirzepatide, which is Mounjaro and Zepbound. And what they found was that over time, when adjusted for characteristics of these patients, Mounjaro, which was the diabetes drug, did a better job of weight loss. No surprise there. We saw that during the phase 3 trials. What is interesting is that in the initial look at the study, Ozempic looked like it was faring better for weight loss. But then once they adjusted the patients that they were looking at, that's when they found Mounjaro to be better. This was not a randomized trial. It did not include a head-to-head actual study. This was sort of a retrospective look at patient information from pharmacies. About 9,000 patients were looked at, and that's where this information came from. So while we do already know that the weight loss drugs for both these companies, have a bit of a difference, this kind of puts it in a different light. We also do know that both companies contend that this was looking at the diabetes drugs and diabetes patients, when we know that the higher doses for both drugs actually encourage greater weight loss because there are higher doses of each formula. So that is really some of the nuance that goes into this. But of course, we know Novo shares slightly under pressure because of this.
I was prepared. I didn't know if I was going to be able to follow you throughout that report, but I think we got it. You got it?
I got
All right, good.
Okay.
We're all on the same page, right? 100 great stuff. Thanks so much. Keep right here on Yahoo Finance. We've got your opening bell in just about 2 minutes. We'll be right back.
There you go. That is the opening bell on Wall Street and in Midtown Manhattan at the Nasdaq, where you've got the Chicago Innovation Crew ringing the opening bell at the Nasdaq in Midtown. Okay, all right. Different type of city, different type of vibe, but they're bringing it there with the funfetti. And then you got Genworth over at the NYSE. Let's get you a check of the markets, sponsored by Invesco here as you're watching Morning Brief on Yahoo Finance.
All right, well, as we take a look at the opening trade, we're coming off another record-setting close here for the S&P and the Nasdaq, so we'll see whether or not that momentum carries into today. We're 30 seconds into the trading day, and we're looking at this slight move to the upside. You got the S&P up just around 0.1% here. When you take a look at the Dow, under just a bit of pressure, although not too much to the downside, off just about 50 points. Taking a look at the sector action. We're seeing a bit of a mixed picture. You got communication services, technology, once again leading the way. On the flip side, energy being the worst performer. And Brad, you want to take a look inside the at the Dow?
I would love
Dow
to. 30 components. You love to talk about them. Ladies and gentlemen, boys and girls, take a look at what we got here shaping up on the day. Look at this, the biggest mover, Intel, out of the gate this morning. That's up by about 2.7%. We don't get to see that all the time, so we had to call it out. Also taking a look at some of the other major movers, both to the upside and downside. Doesn't seem like there's too much deep red, but it is coming in the form of Chevron. Seems like there's a little weariness across that trade thesis right now, as we had seen Exxon. We've also heard from BP, as we were just breaking down a moment ago, and some of the guidance adjustments that have come through on that sector.
All right, well, let's talk about what's going on in the energy sector with commodities. Jared Blickery has a closer look at that. Jared.
Yes, thank you. I love your enthusiasm for Papa Dow. I'm looking at energy. Energy is the weakest sector of the day. I'm going to pull up the Wi-Fi Interactive behind me, where we can see the futures action. And specifically, I want to call out WTI crude. You can see underbid a little bit of pressure today. This comes as the tropical storm Beryl, now that it is a tropical storm. It landed in Houston as a Category 1, much lighter, much less damage than people thought. In fact, refining operations, they did close down, and they're going to restart soon if they're not already. Really didn't suffer much damage. So kind of a sigh of relief there. Let me put a 1-month chart so you can see in the lead up to all of this, we did see a price rise, and you can see we're still up. This is WTI crude. We're up 5% over the last month. We also have the situation Gaza. Is there a ceasefire? Is there not? That kind of changes on a day-to-day basis. But nevertheless, we're looking at WTI with an 81 handle right now. And also checking out Brent. Let's check out BZ equals F. That is at $85.29. Oh, one more thing. Just want to mention that BP and Exxon are guiding lower expectations regarding refiner margins. Exxon expected to take a $1.5 billion profit hit, BP about $2 billion. So watch for that in the coming weeks as the majors start reporting earnings.
All right, Jared, thanks so much. Let's continue the conversation with crude prices slipping after Tropical Storm Beryl making landfall in Texas this week, but causing less damage than maybe the market had initially anticipated. Optimism on recent ceasefire talks between Hamas and Israel also putting some pressure here on the price of oil. Let's talk about where we are headed next. And for that, we want to bring in our next guest. We have Vandana Hari, Vanda Insights founder and CEO. Vandana, it's great to talk to you. So we just heard from Jared just some of the pressures that's going on right now within the energy space, specifically maybe on the price of crude. I'm curious from your perspective about the recent price action that we've seen, maybe what that tells us about what we could expect in the coming days.
Yeah, good morning. So you were mentioning Hurricane Beryl. That was certainly a factor because in the lead up to Beryl lashing the various Caribbean islands and then Mexico and Texas, there was fear in the market, and justifiably so, because the offshore U.S. Gulf of Mexico is a major oil producing area. Nearly 1.9 million barrels per day is pumped out of that region. And then, of course, in Texas and Louisiana, you have nearly 40% of U.S. refining capacity concentrated in just those two states alone. And then, of course, in history, we have seen hurricanes capable of wreaking a lot of havoc and damage to infrastructure, both offshore as well as onshore in the refining segment. So there is a sigh of relief there, but there's another angle there as well. In the aftermath of such a hurricane, there's no damage, but typically what happens as the residents of the states hunker down is that fuel consumption goes down. Now, we won't see those numbers in the EIA report due out tomorrow, but we'll probably see them next week. So it's a sort of a double whammy for oil sentiment. But that alone is not the factor. When prices hit 9-week highs last week, Brent above $87 a barrel, it was a slightly overcooked. There's this narrative of summer oil demand bump, which has been going around. But I think the market is now starting to recalibrate that a little bit. So jet fuel demand is doing well. Air travel is doing well the world over, certainly in Europe and the US. But gasoline and diesel demand almost all over the world, and including here in Asia where I am, is really not doing too well. It's quite sluggish. So all in, the picture for oil demand is perhaps not that strong as what the oil bulls might have expected going into June.
At what point do we see a full pivot in the narrative from the pump, as you mentioned, in the typical demand profile that was expected coming into the season to a full-on slump?
So it really depends on the conviction of the bulls in the market. Summer is not over by any means, right? So we have July, August, and even September, if you're talking about the Northern Hemisphere holiday travel season. The market will take its time to sift through this. But in the meantime, as you were mentioning, there's also the geopolitical fear premium. On the Gaza front, it has receded again quite a bit, but it still is there a little bit when it comes to the Ukraine war. It's intensified, the fighting between Russia and Ukrainian drone attacks on Russian refineries have also been, consistently going on. So there are still price supportive factors, I would say. And let us not forget, one hurricane has come and gone, but this season is predicted to be one of the strongest in living memory. So I think that will keep the market on tenterhooks.
Vidyan, I'm curious what you're seeing just in terms of what you're expecting, maybe is a better way to phrase that, for demand versus supply, and whether or not demand is going to outstrip supply anytime soon, or if it's going to be more of a continuation of the fact that we're going to continue having a bit of this supply surplus, at least here in the U.S.
Yeah, so if you talk about the global supply scene, OPEC Plus is going quite steady. We know that they are keeping their current quotas and production targets in place until September, after which actually they're going to ease supply. There's going to be more supply gradually coming back into the market, about 2.2 million barrels per day that 8 members had cut back. They'll start releasing it starting October of this year. So when it comes to supply, really, it's the big picture is stability. I would say the only wrinkle and the wild card there is the hurricane season, because as I mentioned, 1.9 million barrels per day of oil production in the U.S. Gulf. And U.S. is now not just a major producer, but a major exporter of crude as well. That could cause periods of tightness. I do believe that if a really severe hurricane were to hit production upstream or downstream in the U.S., probably it will be time to release some more strategic oil reserves. I mean, I really can't see how the U.S. administration would stand by and watch oil prices, crude climbing above $90 in an election year at that.
Vandana Hari, who is the Vanda Insights founder and CEO. Great to have you back on here with us. Appreciate it.
Thank you.
Coming up, everyone, Tesla shares moving slightly lower this morning after notching a 9th straight day of gains. But how long will the rally last? We'll discuss on the other side of this break.
All right, welcome back to the Morning Brief, brought to you by Invesco. After a slow start to 2024, Tesla making a comeback. The stock's 9-day winning streak erasing the losses that we saw year to date. You're now looking at gains since the start of the year of just over 2%. Now, the extended momentum that we have seen, the extended rally, comes as the car manufacturer really beat on quarterly deliveries just a couple of weeks ago here. So for more on Tesla's run, we want to bring on Seth Goldstein. He's Morningstar's equity strategist. Seth, it's good to see you. So certainly there's no shortage of excitement surrounding Tesla right now. When you take a look at those delivery numbers, it was enough to excite many on the street. You're looking at a rally here of just about 40% since the beginning of June. Do you think these gains that we've seen over the last couple of weeks, are they justified given the numbers that we did see and the fact that it was still a drop from a year ago?
Well, I think what we're seeing is when the delivery numbers came in above consensus, Tesla is a very high growth stock, so the market reacted very positively. And then you have some momentum from Tesla's AI businesses, which the market is giving extra value to. And so you have Tesla, all of a sudden the market is valuing the growth potential for Tesla. Whereas if you look before the deliveries, Q1 deliveries, I think, surprised to the downside. And so the market was assuming a lower growth rate. And so that's why we've seen the large rally since the deliveries numbers.
Okay, and so as we have the deliveries, the production numbers, going into the next financial performance print, once that's fully unveiled, when earnings drop, what do you anticipate Elon will need to signal to the investment community about the future construct of how they're thinking about production and the new vehicles that they teased and now the street's going to be expecting at some point?
Yeah, it's a great point. I think we're going to need to see a solid, concrete timeline, and that the timeline has not pushed back for the new, more affordable model. Last quarter, they said it was going to be by the end of 2025, so we need to see that being met or pushed up earlier, so that the street can assume that Tesla will see a second wave of deliveries growth starting in 2026. As long as that narrative remains intact, I think that the stock will be okay. But if that's pushed out, if management sounds more uncertain that that's going to happen, then I think we could see the stock falter as, the market may be assuming that this second wave of deliveries growth either won't happen or will be pushed out into the future.
What type of vehicle, what type of model should customers be hoping that this vehicle is, and perhaps investors too?
I would think it would be maybe a smaller size SUV, so maybe a little smaller than the Model Y, but at a price point that's comparable to more like a Honda CR-V, Toyota RAV4, something in the mid $30,000 range versus the current Model Y, which is the next leg up. And so, if Tesla can offer that, then that gets them into a more affordable vehicle segment that's a much larger market in the US. And so I think that would drive, many consumers who are considering an EV, but one is still a little too expensive for them, that would push them over to buy an EV.
So I think one of the big questions here for investors is surrounding profit margins and whether or not we are going to see much improvement there. Are you expecting improvement? And if so, or even if not this current quarter, looking out then into the second half of the year, what do you expect will drive that?
Yeah, so I don't think we're necessarily going to see much improved profit margins. If anything, we might see margins slightly fall in the second quarter versus the first quarter. But I do think in the second half of the year, as Tesla starts to realize lower unit production costs, lower raw materials, that they should see expanding profit margins sequentially starting in Q3 and Q4, setting them up for a profit growth return in 2025.
Does Tesla have a quality assurance or quality delivery issue right now? I mean, some of the early reviews that we had seen of the Cybertruck, and we're not even a full year into these things being on the road and being an absolute eyesore at this juncture, and people are already talking about how it didn't meet some of the expectations that they had, especially as they were finally able to take delivery.
Yeah, I think the Cybertruck, we didn't get the range that we wanted. Some of the features that were initially promised were not quite delivered. And then we saw a recall where, they did not have the manufacturing high quality that we've expected with other Tesla vehicles. But, it's a new vehicle. So I think really the first year of a new vehicle, I would expect Tesla to work through the problems, work through the mass manufacturing issues as they're scaling up production. And so I don't think it's going to be, any major issue that they can't overcome. Just, maybe not as smooth a production as many had initially hoped. That being said, I do still think the Cybertruck offers, a unique Tesla product. It does showcase some of their high quality technology. And, I do think that it helps drive the brand and helps, make consumers more aware of Tesla when they're looking at luxury vehicles.
Seth, my question to you is about the election. When it comes to President Trump, he's had some critical words just in terms of Biden's policies towards the EV market, saying that he wants to undo some of those policies, some of those laws. He's called them, quote unquote, crazy. With a Trump presidency, is that bad news for Tesla specifically?
I don't necessarily see it as bad news for Tesla specifically. Even if Trump were to win the White House and overturn the Inflation Reduction Act, so getting rid of EV subsidies, I still think that Tesla has been able to move into lower and lower price points over time. And with that new affordable vehicle, you're looking at an entry-level price that's going to be on par with comparable internal combustion engine vehicles. So if it is something in the mid $30,000 range, at that point you don't need subsidies to set the price parity. And as we've seen in China, when electric vehicles reach price parity, you get a whole lot of consumers move from interest to buyers. And so, we also have the infrastructure law that's funding the build out of high powered EV chargers along highways. That's the other big thing missing that's making consumers hesitant to buy an EV. So with more chargers being built out, with more affordable EVs, I don't think that Tesla would really, see a huge dip in sales, even if Trump wins and the Inflation Reduction Act gets, overturned.
Seth, do you think that's the case for other EV makers as well?
Well, I think for many EV makers, it's the political environment isn't the big issue. It's can you profitably mass manufacture cars to turn a profit, generate positive free cash flow, or will the losses continue? Will you have to continue to seek alternate financing and shore up your balance sheet? So I think that's going to be the issue, regardless of whether Biden or Trump wins the election. That's really going to be the big issue for any EV startup. That Tesla's already profitable. They're already generating free cash flow. They have a strong balance sheet, so they don't have to worry about that. They've moved past those issues. But for earlier stage EV makers, that's the big hurdle to overcome, regardless of who's in the White House.
Yeah, could be a down ballot issue as well, considering where the full self-driving ambitions are for a lot of EV companies right now, and that would be a hit to some of those Tesla autopilot taxi ambitions as well. Seth Goldstein, thanks so much for taking the time here with us. Morningstar equity strategist. Great to have you.
Thank you.
Thanks. All your markets action ahead. Stay tuned. You're watching the Morning Brief. You're watching The Morning Brief, brought to you by Invesco. The S&P 500 and the tech-heavy Nasdaq are on a tear this year, both up double digits. The S&P 500 notching its longest win streak in 5 months. But Morgan Stanley's Mike Wilson told Bloomberg that a 10% market correction is likely sometime between now and the election here. Now, we're taking a look more broadly here at the year-to-date charts, but one of the massive things that you have to think about is the different events that are set to take place and could be triggers of that correction, whether it's a sell the news type of event, the Fed maybe starting their Fed rate cutting cycle. And then additionally, of course, you have the event of the election itself. But leading up to that, there's a larger question mark looming for the Democratic Party of whether or not the current president, who is the front runner for its party and convention going into the convention, is set to potentially pull back or pull out of the race as well.
Yeah, I think longtime bear Mike Wilson's back. He had tempered his expectations most recently on the heels of that massive rally that we have seen play out in the equities markets over the last couple of months here. But what he's essentially saying that the market needs to brace for is some choppiness leading up to the election, saying that the third quarter is going to be quote unquote choppy. And he goes on to list the election as some of those reasons. The pullback, though, he's saying may offer some opportunities. He doesn't look at valuations as exciting right now. And he also went on to say, quote unquote, your likelihood of upside from now until year end is very low, much lower than normal. And he placed the odds of the stock prices actually closing higher from current levels, and now at just 20 to 25%. So again, just striking a tone that we have heard, maybe just in terms of that cautionary tone that we've heard from some on the street. And maybe they're not saying that the pullback will be to the extent of 10%, but they've raised some concern about the concentration that we've seen play out in the markets, the fact that it hasn't exactly, we haven't seen a wider breadth up until this point. And then some of that momentum seems to be maybe leaving the market here when you take a look at some of those larger cap tech names, some of that AI excitement. So there has been alarms, or maybe some red flags that have been raised on Wall Street over the last several weeks.
I really enjoyed hearing what Liz Ann Saunders was reminding us of earlier in the show as she was talking about some of the psychological element of the trading that we might see really come into the forefront. And then that is really looking at some of the profit taking that could come forward in some of the sectors that have been extremely overcrowded, or the trades that have been extremely overcrowded. And then now what a rotation or pulling some chips off the table, or at least trimming positions, could mean as related to a correction. Because if you did see those that trimming of positions happen in a larger wave, then that's the volatility you're looking for on one instance. And then it's people sitting on, or investors sitting on, some of that cash to try and decide where they would deploy it next, and how long they sit on that cash could eventually get us to what Mike Wilson is talking about in a 10% market correction.
All right, well, keep it right here, because coming up, Fed Chair Jay Powell, he's getting set to testify before Congress. That testimony kicking off at the top of the hour. We will discuss what investors can expect to hear and exactly what we could maybe shed some light, if Fed Chair Jay Powell is going to shed any light on where he sees the battle to tame inflation. All that coming up next on Catalysts. Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Fed Chair Jay Powell kicking off his 2 days of testimony before Congress today. Will he give investors any insights about the potential for a September rate cut? We'll discuss.
And foreign leaders are meeting in Washington, D.C. for the 75th NATO summit. Pressure will be on President Biden as he looks to reassure allies as well as American voters that he's fit for another 4 years.
And we've got earnings season just around the corner. Analysts at big banks are expecting corporate America to deliver yet another blowout quarter. We're going to discuss how earnings could impact the current market rally.
First, Fed Chair Jay Powell's semi-annual testimony before the Senate Banking Committee getting underway as we speak. Yahoo Finance Fed reporter Jennifer Schomburger has the latest on that for us. Hey, Jen.
Good morning, Shauna. Fed Chair Jay Powell appears to be inching closer to gaining the confidence needed to cut rates. Expected to say in his semi-annual testimony before the Senate this morning that he's encouraged with the latest cooler readings on inflation data and that more good data would strengthen his confidence. Powell expected to say in prepared remarks that, quote, the most recent inflation readings have shown some modest further progress and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. Now, Powell did reiterate that the Fed won't cut rates until officials have gained greater confidence that inflation is falling sustainably back towards 2%. Powell noted that the Fed will continue to make decisions on monetary policy on a meeting-by-meeting basis. He reiterated that lowering rates too quickly could reverse progress on bringing down inflation, while keeping rates elevated for too long could weaken the economy and the job market. Republicans expected to press Powell on bank capital rules, while Democrats are expected to pressure him to lower rates. Senate Banking Committee Chair Sherrod Brown expected to say in opening remarks this morning that, quote, keeping rates too high for too long threatens workers' paychecks while keeping other costs high, particularly housing prices and rents continue to go up. Perhaps in anticipation of that, Powell expected to reiterate in his opening testimony that the Fed is committed to bringing inflation back down to 2% and underscored that Congress has entrusted the Fed with operational independence to take a longer-term view to meet the goals of maximum employment and price stability. This hearing coming ahead of a fresh reading on inflation due out Thursday on the Consumer Price Index, investors pricing in a better than 70% chance that the Fed can initiate its first rate cut come September. The hearing kicking off right now in Washington, where Powell will face more than 2 hours of questions from senators. We'll see whether we get any more clues as to when the Fed could lower rates.
All right, Jennifer, thank you so much for joining us on that. We really appreciate it. For more on Powell's testimony and the prospects of an upcoming rate cut, we're going to bring in Deepak Puri. He's Deutsche Bank's Private Bank America's CIO. Thank you so much for being here with us, Deepak. I want to talk about this specific quote that we're getting in right now from Jay Powell, saying if we ease too little late, that could unduly weaken this economy. If you are in your role right now throughout the rest of the day here, how much of a bullish signal is that for the markets today?
Yeah, thank you, Madison, for having me. I think these comments are not too different than the ones Chairman Powell had for Sintra the last week at the ECB forum. And you can feel that the Fed is facing the pressure now of making this, the labor market statistics, which are starting to come in much weaker than expected. Just to give you an idea, the unemployment rate now at 4.1%. The median reading on the June SEP was 4%. So that's, can give the Fed a little bit more of a platform to start talking about a rate cut. As your reporter said, 75% odds of a September rate cut. I think that's a pretty decent, signpost. However, I would like to caution the listeners just to think about that rate cut is a panacea for another leg up in the market. Just look at what happened at ECB. ECB cut rates June 6th. And the Euro stocks are actually down 2.5% over the last 1 month. So a rate cut does not necessarily mean that it's going to be a catalyst for another leg up in the equity markets. I think there's a whole host of other factors at play here. And, there's a saying, don't really fear the pause, fear the cut, because a lot of unknowns are still there with regards to the cuts, the magnitude, the duration, what really is the R neutral. So a lot of those questions are going to be, the markets are going to be facing those questions come the time of a rate cut.
Deepak, given the comparisons that you just made to what happened now when the ECB cut rates, do you think it's going to play out then similarly here in the U.S.? Just in terms of the immediate pressure that we could see on the markets?
Sure. I think, the economy has withstand a higher rate of interest rates. So that's something that we should all take a little bit of confidence from. However, the fiscal impulse might be missing this time around. And why do I say it? It's an election year. No matter who comes, in the White House next year, the chances are that you're not going to have the same kind of deficit spending that allowed us to have a really strong recovery post the pandemic. So the first case was that the market, given the fiscal stimulus, was able to, overdo the monetary policy tightening. However, if the monetary policy is still tight and restrictive and the fiscal impulse is not there, how would the economy react? That's a big unknown. That's a big question mark. So I feel you don't want to just get carried away by this narrative that the rate cut is going to really start solving all our issues with regards to the deficit spending, and the market's going to go up on a linear projection from here on.
Well, I'm curious then, what are you thinking, not just of the upcoming earnings cycle here, but of the third quarter earnings cycle? We're hearing some analysts coming out saying that they expect choppiness in that third quarter. What do you think?
Yeah, I think the high water mark might be the second quarter. I mean, in terms of EPS growth year over year, you're looking at a 9% increase for the second quarter. And again, the focus is going to be on the big tech, July 22nd week, because that's where, you're looking at 30% increase, over a year ago on the earnings side. I think when you look into the second half of the year, Madison, you can easily make a call that things should start to ease out a bit, meaning it should not go on at 9-10% clip, especially given the length of the monetary tightening that we have seen. And even though there is some case for optimism that can be made, most companies are still saying that the pricing inputs are still above. So they're not really doing CapEx spending. They're not really hiring as much as you would like to see. And labor market statistic that I quoted earlier, a case in point. So I think you are going to see a relatively good number this year. We are looking at $245 for the full calendar year 2024, which can ease up to, go up to $265, $270 come next year. So it's not a bad earnings backdrop. However, it's going to be very sector specific and it's going to be very industry specific. So being a little bit more, active makes a lot more sense.
And Deepak, going off of that, what you were just saying there, given the fact that the earnings bar has been set so high this quarter, those companies that do beat expectations, exceed what the street is looking for, will they not be rewarded at the same clip that they have been historically speaking?
I think they will be, because we are in a slower growth environment. So growth is at a premium in a slower growth environment. So the investors might, reward those companies who are gaining market share, whose top line revenues are beating estimates, and have the pricing discipline. So I think all those things are very important. Having said that, I would not rule out the AI tailwind as well. Last couple of quarters, around 20-25% of the earnings reports have mentioned AI as a possible way to gather market share. I think that trend probably also continues this time around.
All right, Deepak Puri, great to have you here. Deutsche Bank's Private Bank America's Chief Investment Officer. Thanks so much.
Thank you.
We are going to take a quick break here. We'll be right back. Just about 40 minutes into the trading day, you're looking at gains for the S&P and the Nasdaq. The Dow, though, under a bit of pressure. We'll be right back. The annual NATO summit kicking off today in Washington, D.C. amid heightened geopolitical tensions. And as the three-day summit gets underway, President Biden will also be fighting to prove that he's fit for a second term and put some of those concerns to rest about his ability to lead. For more for what's at stake, we want to bring in Jim Townsend. He is the former Deputy Assistant Secretary of Defense for European and NATO policy. It's great to have you here. So let's just start with what is at stake here for President Biden specifically, and even beyond the foreign policy measures, which will obviously be talked about here over the next 3 days. What do you think, or does he need to prove anything to foreign leaders that he is fit for a second term?
Well, he does have to prove to foreign leaders, but I think more importantly, he's got to prove to the American people and certainly members of his own party. He's got a press conference that he'll give at the end of the summit, where traditionally the president talks about the things that have been decided and it presents the successes of the summit. And we'll be watching carefully how he speaks, what he does. That'll be a big test both for the allies as well as the Americans.
It's interesting because Biden is not the only political figure who is participating this week, who is facing a little bit of pushback from the electorate back at home. I think of Olaf Scholz, for example. What does that do to the overall potential for action items to come from this week, given that you've got so many of these political figures who are facing a lot of volatility for their own jobs, really?
Well, you're right. The UK is bringing a brand new team, Labour team, to the summit. Of course, Macron has shown up. He's a weakened French president with a new team as well, or at least a team that's a bit of a caretaker status now. So they do have an impact on what's decided. It's not going to be as great as one thinks because much of this was decided earlier on by former governments. But the new ones are coming in. This is a test on how they present themselves publicly. There won't be decisions made because those, again, have been decided earlier, too. A lot of this is how they get along with their new colleagues, how they present themselves in their country publicly. There's a lot of public events during this 75th anniversary. So the impact really won't be felt until a couple months from now when new issues come up. New decisions have to be made by these new teams, and we'll see how well they do.
My question to you is also when it comes to the possibility of a second Trump presidency, when we think about everything that he has had to say, very critical of NATO during his first presidency just a couple of years ago, what do you think the future, and this would probably come up in some regard, you would think over the next 3 days, but the U.S.'s role in NATO, what do you think that will potentially look like if we do see former President Trump elected here for a second time?
Well, that's the question all the allies are asking. They are already in town. They went to a baseball game yesterday, and there've been some receptions since. And as I've talked to them, that's always the first question. So what's going to happen if Trump is elected? Will it be different this time? What's the possibility? So I think the point I've been making is that the NATO that Trump would deal with, if he's elected in November, the NATO that he will deal with is different than the one 4 years ago. It's been facing Putin. It's been at war, if you will, on the European continent for a while now. The allies are spending a lot of money on defense now. There's quite an effort in Europe to reach the capabilities that Trump 4 years ago said that NATO nations needed to do. So his argument that the allies are free riders, the allies aren't doing enough, that argument doesn't hold anymore. So if he were to become president, he's going to have to get used to a new NATO, a wartime NATO, a NATO where the allies are doing a lot, particularly assisting Ukraine. In fact, in some areas, they're doing more than the U.S. is doing. So we'll have to see. But at the same time, the anxiousness level, if you will, of allies is off the charts right now, watching what might happen.
How could a Trump presidency impact the overall picture in Ukraine? To what extent is that a potential headwind for Ukraine in really getting the support it needs moving forward in this effort?
Well, for sure, that's what Kyiv is anxious about. Other allies are anxious, too, because they don't want to be left alone dealing with Ukraine and Putin. Should Trump make a decision to disengage a bit from NATO? We hope that's not what he does. But this would definitely have an impact, particularly if Trump makes a separate deal with Putin. And Putin says to Trump, look, I don't want NATO on my borders. I want you to get U.S. forces out of Europe, or I want to see the U.S. not do as much for Ukraine. If that's what Putin's asking for and Trump is willing to give it to them, that's where there's the problem, I think, is that relationship between those two more than anything else and how that might play out.
Jim, I know you're very experienced in working with European and NATO policy, and in your tenure, you've also specifically worked on the challenge of Russia in Europe. I'm curious just your thinking as the war has continued, if you've been surprised by the length of it, and also if you were in a position to advise whoever ends up in the White House come November 5th, what would you tell them to do in an effort to bring this war to an end?
Well, that is the great question, and you're absolutely right on all of what you've said. There were a lot of surprises. There was a lot of underestimation of Ukraine, overestimation of the Russians, and also surprise about how warfare in this day and age burns through so much ammunition and so many end items. So I think we have been finding ourselves not making the right decisions all the time in terms of the kinds of support that we need to give Ukraine. The bottom line is that right now it's almost at a stalemate. There was a time when the Russians just a few weeks ago looked like they were quite on the march, but Ukraine has held them back. Things have frozen on the battlefield now, and so I think the administration, whoever comes in November, is going to have to deal with this problem, which is if you want Ukraine to win, you're going to have to give them a lot more equipment and more sophisticated equipment than we have given them in the past. If you're afraid of upsetting the Russians, if you're afraid of escalation, then Ukraine will probably not win back that land that was taken from them by the Russians. So there's some fundamental decisions that have to be made by this new administration coming in. Either you're going to give them what it takes to win in terms of Ukraine, taking back their assistance, taking back the land that they lost to Russia, or they're going to have to cut a deal. And if a deal is cut, it means that Ukraine will probably lose that land that the Russians have taken. And that's what we're faced with. The new administration is faced with some pretty stark decisions coming up.
Jim, when you take a look at the tragic events that have played out, obviously over the last several months, but this week with the hospital attack from Russia in Ukraine on the pediatric cancer hospital, does that prove that even with this historic aid package that we're expected to be announced here at NATO for Ukraine, that Ukraine, in fact, does need more aid? And how much more, I guess? That's the question many foreign leaders are asking. But from your experience, how much more assistance do you think Ukraine needs ultimately if they do want to come out victorious?
Well, for sure, in terms of just needs today, air defense is just critical. We haven't given them enough. Whether it's Patriot systems from the United States or some European air defense systems. Obviously, your pictures show right now the destruction that comes when you don't have enough air defense. So that's a today problem. If we want them to win, we're going to have to help them deal with a manpower shortage that they have. There's not enough Ukrainians to really fill out the military to the degree they will need to have if they're going to push back on the Russians, who have more. They're going to need armor. They're going to need those F-16s that were promised with munitions and fuel and all that comes with having a modern Air Force. They're going to need drones and sophisticated ways to counter Russian drones. There's so much more, unfortunately, that Ukraine is going to need if they're going to take back the lands that they've lost. And we'll see if the allies are up to that. We'll see if the U.S. is up to that. And if we're not, then we're going to have to get used to the idea that the land that the Russians have taken might never be given. Ukraine may never get that back, and that's part of that fundamental question that's going to have to be decided by Ukraine, talking to its allies, and we hope that we agree that we're going to give Ukraine what they need, but it's going to be a lot and it's going to be expensive.
Yeah, the stakes of that, of course, incredibly high, Jim. Thank you so much for joining us. We really appreciate your insights. That was Jim Townsend. He's the former Deputy Assistant Secretary for Defense for European and NATO policy. We're going to turn our attention now to Tesla. Short sellers are feeling the brunt of the stock's recent rally. A growing number of hedge funds had piled into short bets back in June. And according to data provider Hazeltree, about 18% of the 500 hedge funds that the company tracks had a net short position on Tesla as of last month. And that is the highest percentage in more than a year. Since the beginning of June, Tesla's share price has now soared around 40%. So bad news for those short sellers. Joining us now to discuss, we've got Ihor Dushanowski, S3 Partners Managing Director. Ihor, thank you so much for joining us. You've spoken about this publicly before here, so I want to get a number from you. How much have Tesla short sellers lost since the stock made its public debut back in 2010?
Right now, it's above $60 billion. I think it hits around $63 billion as of right now.
So $63 billion. Is it just too expensive for anyone to be betting against this company, regardless of their fundamentals?
Well, short sellers have been up and down in this name over the past couple of years. It was the number one short in the market. Now it's down to number 4 behind NVIDIA, Apple, and Microsoft. So there has been a little bit of give and take in the name. But short still, this is like the OG short. Everyone's still in it.
Yeah, Ihor, that's what I wanted to ask you. Just how often do you see traders, investors shorting a name like Tesla? When you take a look at this activity that we see now, comparing that historically, is it anything really out of the ordinary? It doesn't sound like it.
Well, we are seeing some short covering recently. I mean, there's been a little bit of a squeeze, short covering going on, and it's a really important name for a lot of hedge funds, because this is the volatility that people are looking for in order to make a good profit, in the name. You can get big bang for your buck.
So I want to talk a little bit more about this, because we have investors who come on and talk about the upcoming announcements that are going to come from Tesla and really continue to be bullish signals for the name moving forward. I'm thinking about the continuous bullish sentiment around the robo-taxi, for example. To what extent are those investors betting on something that is likely to become a reality for this stock versus just kind of a pipe dream that Elon Musk is more than happy to continue to fuel?
Well, Tesla's always had some, manufacturing, possibilities where they're growing their different type of cars, different type of services in their cars. But really, this name is not just a fundamental trade. This is a trade that's a little more technical market driven, because you've got a ton of long holders that are just Tesla forever. And really, it's what the market is doing rather than exactly what Tesla is doing.
So let's talk about some of the other heavily shorted stocks, at least when you compare it to others. NVIDIA is the latest, is the largest short that we've seen in dollar terms. What do you make of that?
NVIDIA, it's a two-way short. You've got people that are shorting it because it's an overheated stock. They're seeing that, wow, this run-up is just tremendous. It's got to come back to earth. And also now it's a short because it's a hedge to the market. People are shorting NVIDIA in order to hedge their entire portfolio and hedge their tech holdings. So you've got, two different types of short selling going on in this name.
How does that compare to short selling that we might have seen, or any activity we might have seen heading into something like the dot-com boom? Because we continue to have people comparing an NVIDIA to a Cisco, but obviously the company fundamentals are very different. So I'm curious what you're seeing in that comparison.
It's probably closer to an Apple, where people would short Apple because it was the tech name in the market. NVIDIA is now the tech name in the market. So you've got a little bit of a change of the top dog from Apple, Tesla to NVIDIA. NVIDIA is now, by far the largest short in the market. Most dollars at risk.
Should we expect this activity to pick up as we head into earnings season?
Yeah, we're seeing, over the second quarter, we've seen the information technology sector short selling rise by $33 billion. It's still a big short. People are looking at a little bit of a return to the mean, I would guess, where you're saying, wow, this one sector has had such a huge run. Other sectors have to catch up. So I'll go long energy and short info, or short the technology sector. So I think you're going to see continued short selling.
You mentioned Apple, and I'm curious, you cite in your data that it's the most shorted stock over the last 30 days. That really interests me because that's the same window that we've seen Apple really reverse its downward pressure that we've seen over the course of the year so far. What do you make of that reaction to some of the positive catalysts for Apple in terms of just seeing the amount of short selling on this name?
Yeah, again, it's not just fundamental investing here. We're looking at a lot of traders that are looking momentum and technical graphs and saying, hey, you know what, I want to short this name, I want to go long this name. The market is no longer best of breed, worst of breed. It's really you can be as Warren Buffett said, he goes, it's not good enough for you to be right. The market has to think you're right. So more traders are going and looking at recent activity in the short side and kind of running along with that crowd or getting out ahead of the crowd getting out of a name. So stuff like Nvidia, Booking.com, names like in the consumer discretionary like Starbucks and Chipotle. These are names that are getting shorted, and I think more people are shorting these names.
All right, Igor Dushansky, always great to talk to you. S3 Partners Managing Director, thanks so much for hopping on.
Thank you.
Let's take a look at some trending tickers that we have here this morning. Starting it off with Chewy. You're looking at shares falling just around 1.5% after Argus Research downgraded the stock to hold from buy. Now, the analyst behind that call saying that she expects further declines in Chewy's active customers. Christina Ruggieri is that analyst, lowering her recommendation on the stock. She also went on to say that she expects a substantial investment spending as the company looks to expand into Canada. In addition, she also writes the fact that the stock is trading at a premium to its peer group, and that's based on price to sales and metrics that she has seen here. She also anticipates an increase in trading volume and volatility due to some of that shift that we have seen. But again, Chewy shares, they are up on that 1-month chart and that 3-month chart. They are looking at gains. Some of those valuation concerns are coming into play with the rise of nearly 40%, Maddie.
Yeah, and in the note, she talks about how they have been on a run of over 48% over the past quarter. So that's compared to relatively flat results across the Russell 2000 index. So certainly an outperformer when you compare it to its peers on the Russell. It's interesting that the call is relatively short term here. It's really about the valuations that we're seeing with a name like Chewy compared to what she sees their growth looking like in the next couple of quarters. And that's because they're going to be using some of that free cash flow to reinvest in the company. She talks about how they are going in on non-discretionary products and services. Those represent 85% of Chewy's revenue. So the company is going to continue pouring into that. They're working on piloting a vet care clinic this year. That's going to be a high margin service, but it's going to cost them a little bit more upfront on the R&D side of things. So that could be a long-term benefit for the company, but in the short term, it is going to lead to some additional R&D spending that might show up on the balance sheet and therefore in their earnings moving forward here. She does also cite again, as you said, Shauna, the continued declines in active customers and the weakness in the overall economy, adding this to the list of names that we've seen, citing that weakened consumer really starting to buckle under the weight of inflation. I'm curious to see how that shows up in the broader earnings cycle as it kicks off here.
All right, Maddie, let's talk about a name that's under significant amount of pressure here today, and that is Helen of Troy. Shares are falling this morning after a big earnings miss, sinking just over 30%. Now it's marking the biggest drop so far that we have seen on record. Now the company behind the likes of Hydro Flask, Revlon, Drybar, missing analyst expectations on both the top and bottom line, also saying that it expects the problems that it faced in fiscal first quarter to continue. That sales decline led the firm to lower its annual outlook, and that's sending shares falling here today. When you take a look at what they are expecting now, this consumer products company cut its adjusted EPS guidance for the full year. It also missed what the street had been looking for here. When you take a look at some of the weakness within this report, they also pointed to the hair care weakness, that really led some of the drop that we did see this past earnings.
Yeah, it's interesting. I'm sorry, Sarana, to cut you off. I was just taking a look to see, as you were talking, what the kind of sympathy names might look like in comparison here. I'm not actually seeing a lot. If I took a look at Procter & Gamble, Walmart, and Target, actually Procter & Gamble is the only one down today. Not necessarily in sympathy, but it is interesting given that this is the name that's going to be backing, your dry bars, as you mentioned, your Revlon, for example, a lot of those consumer-facing names. Ulta Beauty is down today. That could be a potential move in sympathy with this name because they do cite consumer weakness in particular, and that is just the latest, as we were just talking about with Chewy, right? This is another company citing that consumer weakness. Executives on the call saying as a result, they are lowering, or on the earnings print rather, they're lowering their annual outlook, delaying the delivery of long-term finances in terms of their strategic plan here, citing that consumer weakness, really indicative to me of consumers starting to buckle again under the weight of inflation for some of those discretionary purchases. If you're thinking about a dry bar, for example, that's actually a really expensive product. When I think about their dry shampoo, I'm getting that at TJ Maxx and Nordstrom Rack so that I can get a little bit of a discount because it's expensive, but it's a good product. And perhaps other consumers are doing the same.
Yeah, they are, because beauty and wellness sales, they were off just over 15%. Home and outdoor sales decreasing 8.6%. We do want to bring up maybe the silver lining, a bright spot within this report. The company did say that cost of goods sold actually fell more than revenue, down 17.5% there. But again, some pressure across the board, that weakness of the consumer that you were citing, clearly weighing on this name and expected to weigh now for the current quarter as well.
Absolutely. It'll be interesting to see how it all shakes out with consumer names this earnings cycle. We're going to have all your markets action ahead. Right now, you're looking at a mixed picture across your major indices with the S&P and the Nasdaq up. The Dow is still moving to the downside here. You're watching Catalysts.
a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Bond investors are shifting their strategies, selling emerging market bonds from high-yielding countries where governments have loosened fiscal policies to those undertaking fiscal reforms like Argentina, Egypt, and Turkey. Joining us now with more on this and what to expect in the EM space, we want to bring in Timothy Ash. He is a senior sovereign strategist at RBC Blue Bay Asset Management. Tim, it's great to talk to you here. So when we take a step back on some of the patterns, some of the trends that you have been noticing regarding investor appetite and exactly what that looks like for bonds within the EM market, what are you specifically focusing on, and what does that signal then to us about some of that outperformance, what we have seen, and whether or not it's going to continue?
Well, as your chart suggested earlier, some of those big EMs have had pretty good performance, and we've now seen bottom-up turnaround stories. The last 5 years or maybe more, we just haven't had kind of good individual EM country stories, just highlighting some of those. Obviously, Argentina, new president, Milo, very reform-minded. South Africa, we had elections. We've had a new coalition, a dream coalition between the ANC and DA, and the assumption is that will push on with structural reform. Egypt has been one of the beneficiaries from events in Gaza. They've seen a big bailout from the Gulf states. And Turkey, we've seen a massive turnaround, or a 180, I should say, in terms of monetary policy. After last year's parliamentary elections, we had Mehmet Şimşek reappointed as finance minister, central bank going back to orthodoxy in terms of policy. And investors have rewarded Turkey. And they're actually rewarding countries that are doing the right thing in terms of policy. I could go on. The list is pretty long. Pakistan going to the IMF. We've seen some of the debt distress stories actually beginning to get resolution in terms of debt restructurings, the Sri Lankas, the Ghanas, the Zambias. There's been some really good stories, and that's encouraging.
I want to talk about how that applies to Asia and specifically China. Obviously, the government pushing forward several policies in an effort to get some stimulus going, particularly in the housing sector. What should investors know about what to look at to determine whether or not we've hit a bottom in China in terms of the deceleration of growth?
Well, I'm not sure we really have. I think if you go back 5 years or more, I think the assumption was China would inevitably become the economic hegemon. It would overtake the US through globalization by not getting involved in wars. They had a big balance sheet, lots of FX reserves. They were kind of central planned almost in terms of joined up thinking in terms of economic policy. They didn't make mistakes. What we know now, since the onset of trade wars and increased protectionism, is China actually does make mistakes, and there's overconcentration of power around Xi, less checks and balances. The real estate sector has been a disaster. And actually probably one of the conclusions the Chinese may well have drawn from the war in Ukraine is that if there's this long-term battle with the US, balance sheet is important and building up the defenses. Russia had this fortress Russia policy after annexation of Crimea. It deleveraged and it built up reserves because it was going into some kind of war with the West ultimately, and it kind of did. And the Chinese, I think, are looking at that and saying, well, we face a difficult challenge with the US going forward, build up our reserves, deleverage. And that means they're very cautious. In terms of stimulus, if you think back again in the last 20 years, every global crisis, the Chinese have pumped the global economy, or pumped the Chinese economy to kind of pull the global economy around. We're not seeing that. We're not seeing stimulus in scale. And I think it goes back to this idea it's a very cautious monetary economic policy, I would say, because of this concern about the longer term trajectory in terms of relations with the US. So China, I don't think, is a particularly positive, constructive story. I think they're not going to bail out the global economy with stimulus. They're going to be very defensive. And with this overconcentration of power around Xi, the risks are that he continues to make policy errors. And obviously China is systemic for the global economy. So I think China is still ultimately a risk.
So in our final minute here, to what extent does that play into the likelihood or unlikelihood of China doing anything to increase tensions with Taiwan, which for our audience of retail investors listening, that would be a huge headwind potentially for TSMC and of course a lot of the chip names. So it's something very critical to watch for investors.
Well, short term, I think the China conclusion from the war in Ukraine is that that if you're going to get involved in a war, you need a win. And I think China uses a lot of the military technology derived from Russian technology, and Russia's performed terribly in the war in Ukraine. I think the Chinese will be really nervous about their ability to win a war in Taiwan. In the short term, I think it's less likely. Over the longer term, depends on the decisions taken on the economy by Xi. If he fails to turn around the Chinese economy and it continues to misfire, the risk of Xi, I guess, going to gunboat diplomacy and trying to use nationalism and Taiwan, etc., to improve or to improve his situation at home by playing that narrative will probably increase. So short term, less risk, I think, of a war over Taiwan. Longer term, it depends on the economic trajectory of the Chinese economy, which is not particularly hopeful.
Timothy, thank you so much for joining us. We really appreciate your insights. That was Timothy Ash. He is the Senior Sovereign Strategist at RBC Blue Bay Asset Management. We're going to have all your markets action ahead right here, so stay tuned. You're watching Catalysts. Looking at a mixed picture across the major indices with the Dow moving to the downside, but you got the S&P and the Nasdaq pushing to the upside following Fed Chair Jay Powell's congressional testimony kicking off. We're also currently getting the start of Secretary Yellen's commentary as well this morning, and all of this coming ahead of key inflation data and the start of second quarter earnings. Despite all the potential risks to come, our next guest does say that investors are going to, quote, keep climbing the wall of worry as the bull market continues. Joining us to discuss that and more, we've got Ben Lader, Bradesco BBI Head of Equity Strategy. Ben, thanks so much for being here. So you talk about a midsummer melt up. What do you think is the single biggest driver of that melt up, and how much staying power does it have?
I think there's two. I think there are two drivers of this new bull market that I think we're in the early innings of. One is these upcoming interest rate cuts from the Fed, and the second is this accelerating earnings cycle. I think both are in play, but we're going to get big news on both of those actually later this week.
So, Ben, if the trend then is still to the upside, what do you think the gains look like between now and year end?
Probably cooler than what we've seen. I mean, just to put this in perspective, the first half gains are annualizing at the best year for the S&P 500 since 1995. That's 30 years ago. And what did we hit? Our 30th all-time high of the year yesterday. That's also putting us on track with the 77 we saw in 1995, which was the greatest in sort of recent record. So things are good. But I would expect this to slow a little bit. We've absolutely priced some of these rate cuts and some of this earnings recovery in. But there's also a lot of cash on the sidelines. So, we're overdue a bit of a pullback at some point. But if and when it comes, I think some of this money will just come off the sidelines and buy it.
Ben, what do you think is going to trigger that? Because we have, and I'll just preface that, we've had a number of conversations just about the concentration in the market, the weak breadth, the momentum that we're starting to see a bit stretched maybe at this point. Are those the factors that you think are going to cause maybe a bit of a slowdown, even though it might only be brief, it sounds like?
So your typical year in the S&P 500 has, 3 pullbacks. We've had one. And has a intra-year drawdown of 14%. We've had nothing close to that. So maybe just statistics. 1, 2, we've got a big inflation report coming up on Thursday this week. It's the most important number in markets. It drives everything from the Fed cycle to recession risks and everything else. It's been sticky. More stickiness could, especially after the gains we've had, could give us a little bit of indigestion. And we're coming into earnings season. And, this earnings story has been a one-legged sort of tech-driven stool so far. I hope we begin to see some broadening out, but we're still vulnerable to a tech earnings stumble.
Yeah, a certain bear on the street saying that the third quarter is going to be choppy and that we are due for a, quote, 10% correction. That's quite a bearish call. But then, like you say, adding that this would be a buying opportunity. And I'm just curious if every single dip in this market is buyable because people want to get in on NVIDIA when it's cheaper because the fundamentals are so good, then do we ever really get a correction? Do we ever really get a drop as much as 10%?
That's a great point. And I think that's exactly why we've barely seen one pullback so far this year. Because people are, pulling those triggers early. Nobody wants to miss out, and there's, record levels of money sitting on the sidelines of this bull market. So yes, we may just continue to grind higher. This is why momentum is the strongest factor in markets. So, I think you need to be fully invested. If the pullback comes, fantastic. You get to buy some more.
How should investors be positioning themselves ahead of the election? And I guess how much volatility do you expect that to potentially trigger given the uncertainty surrounding the outcome?
I do think it's a volatility event, not a fundamental event. I think that's what we've sort of learned in the rest of the world, where we've had surprises from India to Mexico to France. When you're sitting on gains and volatilities at record low levels, which is where it has been globally, You've definitely had some volatility, and investors reacted to that. But I think, on the one hand, the U.S. election is the granddaddy of them all, and it started early. U.S. equities, 65% of global market cap, nowhere to hide. It's not France, let alone, anywhere else. But, these are the two best-known candidates that we've ever seen. They've both been presidents before. And I think one of the interesting things in the reaction to the Biden debate, last week, the firming up of these market, expectations that Trump's going to win the election, markets just sort of sailed through that. Bond yields went up a little bit. There was a little bit of volatility, but basically, I think markets have made their peace with a Trump presidency, and I think it's as simple as looking back to the first term and saying, I did okay then.
All right, we'll see how this all plays out. Ben Laidler, great to talk to you again. Brandesco's BBI Head of Equity Strategy. Thanks so much.
Thank you.
Well, the FTC, Federal Trade Commission, issuing a report today saying that pharmacy benefit managers, PBMs, exercise vast control over the healthcare industry here in the U.S. Here with more on the latest on that report, we want to bring in Anjali Khemlani. And the blame seems to be placed on these PBMs for really driving up prices.
Yes, and this is an interim report from the FTC. They've been working on taking a look at the PBMs and trying to figure out where the cost in the system comes from. We know that there have been complaints over the years, and what this report largely did was validate some of those claims, looking at what independent pharmacies have pointed out to, which is sort of a, if you consider it sort of a veering of the prescriptions to their specialty pharmacies. So what the report found, for example, was that the top 3 PBMs, which include CVS, United Health's Optum Rx, as well as Cigna's Express Scripts, account for 80% of the 6.6 billion prescriptions in the US every year. And so that is one shocking statistic. The other being that we've seen the spend of PBMs really increase over the years as a part of national health spend. So for example, in 2016, 14% of the national spend was $456 billion, and that's what the PBMs contributed. Meanwhile, in 2023, they contributed more than $1 trillion, and that was 33% of the national spend. So looking at the vast change that has happened over the past few years, and even in the last 2 decades, decreasing from a market of 30 different PBMs to just these top 3, tells you all you need to know really about this. Now, we did get a couple of responses from the PBMs, looking at Cigna in particular, saying that they are worried about the sort of biased conclusions that came out in today's interim report, and they're looking forward to addressing them with the FTC. All of them have said that they've, over the last 2 years, really given millions of documents to the FTC in order to help frame this report. We also note there is one dissenting opinion from one of the commissioners. So all of this to say that the story is not actually done. What we do know is that some of the complaints and concerns about the opaqueness and the driving higher of prices have been validated by this report, but we're waiting to see a little bit further what the FTC has to say and what they can show in terms of numbers about those increased costs.
Anjali, thank you so much. We really appreciate your reporting on this important news. Thank you. We're going to have all of your markets action ahead, so stay tuned for more. You're watching Catalysts.
Let's take a quick look at the market's action right now, just about 90 minutes into the trading day. You're looking at the Dow still under pressure, off just about 91 points. S&P and Nasdaq adding to those record-setting gains that we saw yesterday, the record-setting close, I should say. The S&P up nearly 0.2%. You've got the Nasdaq leading the way. The market reacting just a bit, although not too much of an impact here from Powell's testimony down on Capitol Hill in front of the Senate committee here today. Powell saying that easing too soon, too much could harm inflation progress. He also went on to say the easing too little and late could unduly weaken the economy. He mentioned some progress here on inflation, saying that inflation has eased notably, but more good data would boost confidence on inflation going forward. So again, a mixed picture here, 90 minutes into the trading day.
All right, well, coming up here, we're going to have Wealth dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts is going to give you the resources, the tools, the tips, the tricks that you need to grow your money. Hey, on today's show, how to position your portfolio ahead of potential market turbulence. We talked to a strategist about the best moves for your money. And the TSA says a record number of people were screened at airports over the weekend. We'll talk to the points guy who will give you the best tips and tricks for your summer travel plans. Plus, trading versus investing. We'll discuss the differences and what's best for you and your money with Yahoo Finance contributor Ross Mack. All that and much more coming up on today's show. Let's check in on the markets as we always do. To kick things off, we are mixed right now across the U.S. major averages. Right now, you're seeing the Dow in negative territory. The S&P 500 is higher by about 0.2%. And the Nasdaq, that's up by about 0.3%. A record-breaking rally for major indices this year, and a lot of that is thanks to artificial intelligence. The chip stocks accounting for 36% of S&P 500 gains so far in 2024. Our next guest thinks that investors should be exposed to the AI trade ahead of potential turbulence this year. To discuss, let's bring in Roosevelt Bowman, who is the Bernstein Private Wealth Management Senior Investment Strategist, here with us live in living color in studio. Great to see you in person.
Thank you, Brad. I appreciate it.
Absolutely. So let's talk about some of the strategy coming off of the first half, where, as we mentioned, the major theme was really generative AI. Yep. And now, as we face the back half of this year and commence that, it's really this focus around, okay, what's the outsized event that could move markets, whether that's a Fed policy move that finally signals what the rate cutting cycle could look like, or whether that be an election type move. How are you kind of anticipating what those factors may be and the correct portfolio positioning going into these events?
Yes, I think starting with the Fed, right, and kind of expectations for where rates will go. I mean, in our eyes, we're looking for a cut at the end of the year in December. Markets are pricing about a 75% chance of a cut in September. That's probably too soon. Mm-hmm. It's possible, but really you would need weakness in inflation and the labor market to all line up. If any of those kind of fall the wrong way, then you end up with a cut being pushed to December. So I think the Fed is less of a story. I do think one of the other major factors, in addition to generative AI, does deal with the path of Fed policy, which is that they really moved to the sidelines in the fourth quarter of last year. So that pushed down interest rate volatility. That really produced a really supportive environment for risky assets, stocks included. So I think that's the other major factor. I think both will still be important in the second half of the year. You mentioned major events. Obviously, everyone is focused on the election. I think there's two parts of that. One, the kind of election-generated volatility. When you look historically over the past 35 years, it's about a 6-week span. Mm-hmm. So for us as strategists, advisors to our clients, we don't want to emphasize 6 weeks when thinking about a long-term plan. The other major question that's come up, of course, is the debt, right? How much we're borrowing in the U.S. and the concerns about that potentially pushing in, interest rates much higher. I think our view is we're less focused on this acute event where rates explode higher, but more thinking about the potential for growth to be a little bit lower in the future because you're taking a lot of those tax receipts in to just pay off your creditors if they're the U.S. government.
That's an interesting point on growth, and I'll kind of preface my next question on growth with this. According to some FactSet data for the second quarter of 2024, as we're about to kick off that earnings season here, the estimated year-over-year earnings growth rate for the S&P 500, 8.8%. And if that's the actual growth rate for the quarter, it's going to mark the highest year-over-year earnings growth rate reported by the index since Q1 of 2022. You hear stats like that. What does that set up for the growth trajectory ahead, as you were talking about where we could potentially see some pockets of slower growth?
Yeah, I think over the near term, we're probably looking at earnings growth that, in our eyes, a little bit slower than that, not materially, but still supportive. I think what we're following is a couple of trends. When you look at the consumer and some of the, I would say, downshifting, if you will, in the quality of goods in certain consumer sectors, and you're also thinking about purchasing power. And so right now, that's been strong for the most part over the past 18 months or so because wages have kept up. But when you kind of look at the savings rate, that's only about 60% of the 20-year average. When you look at wages still firm but slowing a bit, it does leave that opportunity, that room for consumers to potentially pull back, and that kind of leads to our forecast of slower growth in the second part of the year.
Where are the opportunities right now, specifically as you think about some of the other asset classes, whether that be global private credit or real estate debt or real estate equity? Where are those kind of pickable pieces of other asset classes that investors can chart some type of entry point at this juncture?
I think those are three that we've been really focused on with our clients. I mean, primarily because of the fact that interest rates went up so much over a short period of time in 2022, you ended up with this dislocation. If you think about private markets and kind of limited partners and essentially their asset allocations being tilted the wrong way, all of a sudden their private assets are a much bigger portion of their portfolio than their public assets because the stocks and bonds came under massive pressure in 2022. So that's forcing some of them to kind of have to divest faster than they want. That presents a great opportunity for us. I think it's a similar story with banks. If you're a bank and maybe you have some loans that aren't performing well and you have to get them off your balance sheet, well, we're not a bank at Bernstein. That's great. That's an opportunity for us to buy some assets cheaply, whether you're talking about global private credit or commercial real estate as well.
All right, we got to leave things there. Roosevelt, we'll end on a fun note. Which Olympic event you're going to be watching in the next couple weeks here?
Oh, it has to be basketball.
Okay.
But I'm just hoping my Lakers don't get hurt.
There you go. You got a few of them out there competing here. Roosevelt Bowman, who is the Bernstein Private Wealth Management Senior Investment Strategist, joining us here in studio. Thanks so much for the time.
Thanks, Brad. Appreciate it.
Absolutely. A federal judge in Texas blocking a part of the Federal Trade Commission's ban on non-compete agreements for employment set to take effect in the fall. Now, the judge saying the FTC lacks authority to make the sweeping rule, but the injunction is limited. It only bars the commission from enforcing the ban. And to refresh your memory on these rules, it essentially says that non-competes are an unfair method of competition. But existing non-competes for senior executives can remain enforced. But for non-senior executives, those non-competes, not enforceable, unenforceable. And a lot of workers are impacted here. An estimated 30 million workers are subject to non-compete agreements, according to the FTC. And for workers, getting out of them could be tricky and expensive. If a contract is challenged, for instance, employees will have to pay all legal fees. So how can you protect yourself when you're asked to sign a non-compete? First, read the contract. If you can, have an attorney review it even. And don't take it at face value. You can try to negotiate some of the terms as well. The Texas judge says that she intends to rule on the merits by the end of August, which might affect the rules nationwide. Until then, non-compete employees are still bound by the rules of their contract. We'll have continued updates on this here on Yahoo Finance for you. We've also got much more of your markets and wealth building action ahead. Stay tuned. You're watching Wealth on Yahoo Finance. If you go traveling around the world, you are sure to run into fellow Americans wherever you are, according to the Association of American Residents Abroad. Anywhere from 5.4 to 9 million U.S. citizens are currently living outside of the United States. But where are the expats thriving the most? Our own Rochelle Akufo joins us with more. Spicy, Rochelle. Okay, what's going on here?
I mean, you've got to keep your options open. And of course, summer travel has us all comparing the cost of living as we see an increasingly strong US dollar year to date stretching further overseas than it does at home due to inflation. Plus, in what's shaping up to be a tumultuous election year, this is typically when people claim that they're going to relocate. FYI, if you think Canada is your next best option, you might want to sit tight. Now, Internations and Expat Insider rank the best and worst countries for expats. So for the best, you have Panama sitting at number 1, followed by Mexico, Indonesia, Spain, and Colombia. Interestingly, from the bottom 5, Canada, Germany, Finland, Turkey, and Kuwait. Now, when you think of the factors, this study looks at all sorts of things, including your personal finances, your quality of life, your career prospects, your ease of settling in, and of course, your general happiness. So when you're doing some of those comparisons, just keep in mind the countries where you'll actually thrive the best.
Yeah, I went to Spain last year. I was pretty happy, but I didn't move there.
See?
Not just yet, at least. We'll see. The jury's still out on that one. What about the financial realities of relocating overseas?
And that's something that people do tend to underplay, but I've broken down the top 5 financial considerations that people should keep in mind. Foreign earned income exclusion, that's FEIE, and foreign tax credit, income reporting requirements, Social Security and Medicare benefits, retirement accounts, and of course, currency fluctuations. So I'm going to walk you through some of these. According to the IRS, FEIE and the foreign tax credit, that means that US citizens can exclude up to a certain amount of foreign earned income and avoid that double taxation, avoid being taxed in both countries. And this is by allowing a tax credit for taxes paid to foreign governments. Next, you have income reporting requirements. Just because you live overseas, you are not exempt. US citizens must still report their worldwide income to the IRS and file their annual tax returns no matter where they live. And there are also some additional forms required depending on whether your income passes a certain threshold. Next, your Social Security and Medicare benefits that you worked so hard for. Well, the Social Security Administration says you can receive at least your Social Security benefits abroad, but when it comes to Medicare, that typically does not cover healthcare services outside of the US. Now, of course, your retirement accounts. That's a lot of retirees. That's what they plan to do. They plan to live overseas. But think about your IRA accounts and your 401ks. Check with your brokerage account and your brokerage firm, because typically some asset management services become limited to administrative or ministerial use. So, for an example, representatives at Fidelity, if you look in the small print there, they don't engage in discussions about asset allocation, income planning, or portfolio composition, or let you open or contribute to new 521 savings plan accounts or health savings accounts once you relocate. And of course, the all-important currency fluctuations also a key consideration. I mean, imagine your purchasing power fluctuating if you're in a country that does have a volatile currency. That makes it harder to plan financially. So put all the pieces together before you decide to, pick up sticks and move to Spain, Brad.
Thank you so much. Certainly will do. And I got a lot of research to do before that happens. Rochelle Akufo, thanks so much.
Always.
Well, high airfare costs and the threat of a hurricane didn't stop Americans from flying last weekend. In fact, air travel broke records over the 4th of July weekend. The Transportation Security Administration, TSA as you know them, said it screened over 3 million passengers on Sunday alone, marking an historic peak in travel. For more on this, I'm joined by Brian Kelly, the Points Guy founder. Brian, great to see you here today. Okay, so we got to wrap our minds around this. What does the travel demand profile more largely look like here, and how are we seeing people kind of navigate through some of the travel options that remain at this juncture?
Well, it's actually pretty positive for consumers. Capacity is up. And what trends I'm seeing is, there's a lot more flights to Europe and internationally, and there were some amazing domestic deals. So travelers definitely still have that appetite for Europe. Most airlines have boosted their flights to Europe. I was checking for a friend yesterday who wanted to come home early before the storm, and everything was sold out. So I'm not shocked. Even with over 600 canceled flights on Sunday, we still cleared that 3 million passenger mark for TSA, which was the historic record. But guess what? The fare prices are not that crazy. I'm booking in August business class round trip fares to Europe nonstop on big carriers, $2,500 to $3,000. Last summer, those were double. So it's interesting to see capacity's up, but airfares are not quite where I think they should be. And I think we're going to see that in the corporate results as they start coming in later this week.
Why do you think that is?
It's fascinating. I think there are a lot of new low-cost carriers. I think consumers are now splurging for premium economy. Business class, and of course, those traditional business travelers have not come back like they used to. The business class passengers paying $9,000 last minute. It's shocking because even this week, you can fly Air France, Flying Blue, multiple dates from major U.S. cities for 50,000 miles in business class. I've never seen so many good deals in both cash and points. And I guess consumers are traveling. They're going on the deals, but they're not paying the top dollar.
Okay, that's really interesting, especially as it's a consistent thread that we've heard from airline operators, at least on the topic, quarter over quarter. And we're set to kick off some of those earnings this week here as well, with Delta being in focus. A lot of people out there, as we were talking about and really looking at what could come forward for airline earnings here, who are you anticipating will continue to be perhaps the best positioned at this juncture?
I think Delta is going to consistently perform well, as they pretty much always do, although they did revise their estimates down a little bit. I think United is the most global U.S. airline, so I think they have the most upside to be had here. Last year they had some pretty tough cancellations with the 737 MAX 9. I think it's been a much smoother summer for them. So, I would say the underdog here would be United to kind of pull ahead a little bit in terms of profitability. I would look out the U.S. carriers. U.S. Domestic airfares really low. And, with the weather and the storm, I would put my bets on the United and Delta to really keep leading the pack in terms of profits for shareholders.
You mentioned United's annexation and, of course, exposure to Boeing, as many of the other airline operators do as well, especially here in the U.S. Is that deterring travelers at all?
I don't think so. It certainly creates news cycles, just like, these extreme turbulence incidents, they go viral, but people are still traveling. And the fact of the matter is, you don't really have any other options besides Boeing and Airbus, and most consumers are going on price. And that's what works. The airlines know that. That's why they've dropped prices. They're filling planes. They may not make as high of a margin, but they'd still rather have full planes than empty ones, for sure.
Noted, indeed. All right, let's get to some tips here, some actionable tips for those who, over this hurricane season, have plans to travel, have plans to fly. What are some tips for those who do have those existing travel plans or itineraries already marked, knowing it's hurricane season and knowing that they might need to be malleable?
Yeah, so number one, if you're going to go somewhere during the hurricane season, buy travel insurance, and don't buy it through the airline. Go to insuremytrip.com is one of those independent places where you can buy insurance. It's like 5 to 7% of your trip, especially for hotels, that they will not refund you in most cases if there's a hurricane. That's on you to insure your trip. The airlines generally will let you change your flights free of charge. However, if you book through online travel agencies or some random ones, I was talking with one of our followers today, they're having a terrible time trying to get a flight changed due to the hurricane through an online travel agent. So book direct with the airlines as much as possible. And also know when the airlines fall short, go to your credit card. So many credit cards have built-in free protections in the event of named hurricanes and storms. So if the airline doesn't give you what you want, always pick up the phone, call the credit card that you used to buy the ticket, because they can come through and help you with delays and cancellations and getting you rebooked.
Say you just got your flight canceled. How can you get a guaranteed refund?
So the Department of Transportation mandates it. So it may take a while, but you are owed a refund, and do not take a voucher or anything less. You can always file a DOT complaint that forces the airline to respond. And in most cases, you will eventually get your refund. Now, if you're stranded, the airline should rebook you, but often that they're not going to rebook you on partners. So this is where people get stuck for days in airports. You don't have to just fly with that airline. You're going to get your refund. If you have the funds or your frequent flyer miles, rebook yourself on a different carrier, and then place a claim with your credit card company for the difference due to the disruption. Most of those travel credit cards have the travel cancellation coverage built in. You just need to know about it. But do know you are owed a full cash refund if your flight's canceled for any reason by the airline.
Just lastly, while we've got you, Brian, I mean, shoebies, as they've colloquially been called, and summer go hand in hand. You've got tourists, you got visitors in different parts of the world. Barcelona, they're taking a little bit of issue with this, it seems, though. What exactly is happening there? And I mean, does it seem like they're going to cozy up to the idea of tourists continuing to flock to the destination?
You know what? I wish that they were in New York City right now, because I need someone spraying me with a water gun to cool me down wherever I go. But, you know, the protesters there are they're basically against over-tourism. And what locals in a lot of countries, and I was in Portugal earlier this year, a similar sentiment is, okay, tourism's great, but when it's too much, when it's pricing out residents, when people can't afford to get apartments because they're all on Airbnb for tourists, that's when local communities get upset. That's what we're seeing in Barcelona, where protesters are squirting people down on Las Ramblas, which is their popular tourist thoroughfare, trying to prove a point. They do have a very leftist government who has promised to crack down on home rentals and return more affordable housing to the people. But it is a message to tourists: don't always just go to the most populated places. For example, outside of Barcelona, there's so many beautiful little sea towns, Cadaqués, Sitges. So don't just go to the tourist hubs. Branch out a little bit and spread your tourist dollars outside of just those mega city centers.
All right. I went to Barcelona last year before the Super Soakers arrived and the shipment was able to make it to port. Brian Kelly, the Point Sky founder, thanks so much for taking the time.
Thanks for having me.
Certainly. Coming up, everyone, small businesses are feeling uncertainty about the economy. We'll break down why on Wealth. That's next. Small business owners felt a bit more optimistic in June compared to the month prior, but are still pessimistic according to the National Federation of Independent Business. This pessimism is coming as owners contend with industry price hikes and endless hiring struggles. To give some much needed advice for small business owners on how to navigate the current economy is Executive Director of Research at NFIB, Holly Wade. Holly, great to see you, and thanks for taking the time here with us. Let's first just start with the general read-in on small businesses right now. What are they continuing to combat, and what are some effective tools that they have still to be able to deploy even despite some of the pessimism?
Sure, it's great to be with you. And we did see a bit of an improvement in our headline measure of the small business sector, our optimism index, and that was a great sign. We saw a 1-point increase from last month, and it's the highest reading all year. And however, as you mentioned, they're still pessimistic, generally speaking. We haven't seen the index rise up to the 50-year average, which is 98. So we're a long ways from that, about 8 points away from where we would typically be in a good economy for small business owners. And right now, inflation and labor quality are still the two main problems that they're facing. And it's putting a lot of pressure on small business owners to try and retain those current employees, attract applicants for those open positions, and figure out how to absorb price increases that they continue to face.
It's interesting, especially as we think about hiring and compensation struggles for those small business owners. I wonder where and in which industries this is impacting the most.
So right now, for those looking to hire, those that have unfilled job openings, we're seeing a lot of those in construction, transportation, manufacturing, kind of all in the service sector. So all of those industries that we have talked about over the last number of years that are really crunched in trying to find applicants and workers to help them fill orders and generate sales at their business. And that's very frustrating. One of the areas that is causing most of the inflation pressures right now, though, are in compensation. So they're still planning to increase compensation. We saw that tick up this last month. And so they're trying to still figure out how to absorb those prices. First, it hits their earnings, so it's absorbed by the owner's take-home pay until they can figure out how to manage increasing prices at their business, which is certainly a tricky business when they're competing with other businesses, large and small.
That's really interesting because it tells us a lot about the consumer dynamic for a lot of these small businesses and how effective their strategies are at being able to sell to their customers of products or services, knowing that those customers are probably coming back and saying, hey, did you raise the prices on this? And if so, why is that? When can we expect them to abate a little bit? So what is that pricing kind of mechanism or pricing elasticity looking like for small businesses?
Well, it's certainly getting more difficult because, consumers are fatigued with price increases. They're, hesitant to go out and kind of absorb those costs. They're looking to be more strategic about their purchases, which makes a whole lot of sense. And so small business owners, especially when it's the owner, many of the customers know the owner personally. And so making those tough choices of which products or services to increase their prices that will keep them competitive and keep those customers going in or coming into their business it's tricky business for many business owners, and it takes a lot of thought and time and consideration on the part of the owner or an employee having to figure out that composition. But those price pressures are still there, certainly for those in the service industry that are having to pay higher compensation to retain talent. It will continue to be a problem, likely for the remainder of the year.
One last thing that we got to talk about here, some tips, some actionable insights here for small business owners that are navigating the current economy. How can they find some relief in certain parts of executing the business strategy, despite the dynamic that they're seeing on pressure side with labor force and compensation, and then additionally on the consumer side, where they're trying to sell into some of those either larger contracts or even one-time customers?
Sure. So a lot of tips that they've incorporated into their business operations over the last number of years. This isn't a new environment. It's just continuing, and it's kind of becoming a bit more difficult. But some of the tips that they've incorporated and tips going forward are to look at those products and services that make most sense in increasing prices that hopefully you won't lose customers. It takes a bit of thought and time. Unfortunately, that's one of the most valuable resources of a business owner is their time, and they're stretched pretty thin. But every so often, kind of reevaluating which product and services might be most appropriate in increasing those prices, and then also looking around to see what their competitors, what other small, medium, large size businesses are handling their price increases, so that they can try and be in line and continue to be competitive in their industry.
Holly Wade, NFIB Research Director. Thanks so much for taking the time here with us today, Holly.
Thank you.
Certainly. A new study from the Michigan Economic Development Corporation shows that Americans are ready to commit to a green economy and ready to sacrifice their money to buy products made in the U.S. Here with more on this, we've got Hillary Doe, who is the Chief Growth Officer for the state of Michigan. Hillary, great to see you, and thanks for joining the program here with us today. So ultimately, what are you seeing in Michigan that could apply even more so nationally when it comes to this mindset around ESG investments, and particularly making sure that there is the purchase consciousness that also ruminates on the other side?
Yeah, well, thank you so much for having me. So as you named, Michigan is, a clean energy leader. We're #1 in clean energy investment, and it's really important when we think about our economic growth strategy across the state. And so in part because of that, we did lead a nationwide survey of 1,000 U.S. adults, again, across the country. And what we found was that people, really overwhelmingly want to see additional investment in things like sustainable technologies, clean energy, and electric vehicle infrastructure. And again, overwhelmingly, 71% of those folks really believe that even, sizable investments in those sustainable technologies will ultimately pay off. Folks named that they want to see training and pathways necessary to ensure that those kinds of technologies can also be developed right in their communities.
What types of jobs can we anticipate might change or be altered as we're looking at a green economy, and where there are industries that are perhaps most prone to immediately make those changes?
Yeah, well, I would start first by just naming the amount of, economic expansion and innovation we can expect when we look to industry growth here. We've already seen with the CHIPS Act and with IRA some of that federal, opportunity that's caused industry expansion in areas like semiconductors and electric vehicles, and also all the startups. And you were just talking about small business growth that's cropped up around those industries, and we'll continue to see it, both on the design side and R&D that goes into inventing and researching these solutions, but also in manufacturing them. And what we saw in the study was a real commitment from Americans across the U.S. to ensuring that we're both designing and manufacturing these sustainable technologies right here in the U.S. In fact, 87% of folks in the survey named that they would be willing to pay even more for those technologies if they were made right here in the U.S.
It's interesting, and especially as we think about the state of Michigan, a lot of people out there think about Detroit, Motor City, the transition to electric vehicles that have really been a larger ambition for not just some customers out there, but for the industry as well, in its own transition to more environmental sustainability as well. What is the next major sector that you envision could be disrupted by positively or changed fundamentally by some of these environmental investments as well?
Yeah, well, I'm very happy to report I'm coming to you today from Detroit, sitting in what I think is one of the capitals of innovation, because we really are, again, in addition to leading clean energy, really leading the electric vehicle transition. We know that it's critical. Transportation accounts for nearly 30% of our emissions across the U.S., and so electric vehicles are going to be critical to decarbonization strategies. So Michigan has set a really ambitious goal for 100% renewables by 2050. And we're doing what it takes to make sure that businesses can make that transition, and that we have the workforce necessary. Michiganders across our state can participate through training programs and the like in both designing and manufacturing those things. So we're absolutely seeing the future mobility space jump into electric vehicles, seeing a lot of innovation in that space, also in automation and automated vehicles, but also well beyond that. We're seeing a lot of semiconductor growth and clean energy growth more broadly. Again, both in R&D with the University of Michigan leading research and development around semiconductors, but also places like Calumet Electronics in the Keweenaw Peninsula that is leading manufacturing, organic substrate manufacturing around semiconductors. So it's very exciting here in Michigan.
Hillary, we only got about 30 seconds left here, but how would a change in the balance of power in Washington, D.C. and elected officials potentially impact the type of energy or environmental sustainability investments that we could see made?
Well, I would say that these overwhelming majorities in this survey should tell us all that Americans know that, we need to lean into these technologies long-term, sort of irrespective of who's in power, and that this is the future. It's so rare to see 70, 87% of folks all agreeing on something. And so certainly in Michigan, we're making this commitment long-term, irrespective of who's in the White House. And I think Americans are saying that they see economic opportunity here and they want the U.S. to lead here. So I think we should follow their lead.
All right, some really solid readings from the population there in Michigan. Thanks so much, Hillary Doe, who is the Chief Growth Officer for the state of Michigan. Thanks so much, Hillary.
Thank you.
Coming up, everyone, we've got some tips on how to use AI to help score you your dream job. That's next. Are you doing everything you can to find the best job that sets you up for the future? Our next guest is showing job seekers how to utilize AI both in their job training and in choosing the right career path. For more, let's welcome in Chandler Malone, who is the Path CEO. Chandler, great to see you. Great to have you here on the program with us. Let's discuss this a little bit more because a lot of people are hearing AI. They hear AI might be coming from my job, but there's actually an effective way to use AI, perhaps to best fine-tune your career path, how are you seeing this effectively be deployed for potential job seekers out there?
Yeah, definitely. I think this age of AI is very scary for a lot of people. You hear things about automation, you hear things about job displacement. But if you really look at a lot of the research and a lot of the numbers, AI is actually predicted to create more jobs than it's predicted to eliminate. And so, for individuals who are looking to basically be able to adapt to this new age, to this new era, right? I have a couple pieces of advice. First piece is find the things that you're really passionate about and that you really care about, right? That passion is going to allow you to become a subject matter expert. In today's world, right, we're not going to be able to complete more tasks more quickly or with a higher level of fidelity than AI, but we will be able to have a level of nuance, right? We will be able to interact with other humans well. And so being able to have that level of subject matter expertise and then those people skills will allow you to stand out no matter what new technologies come.
Certainly. So say you're on the job and you're trying to figure out, okay, what feels right in terms of eliminating some of those mundane tasks and allowing me to be more productive, while leveraging some of the new technology. Where are you seeing people who are currently on a job effectively leveraging AI to kind of remove some of those tasks that take away time that they could reposition elsewhere?
Oh, yeah. I mean, there are a ton of tools. You think in any industry, there are already tools that have been developed. One tool that I like for Microsoft Excel functions and a lot of folks who are in finance-related roles is called Rose, right? I think we're all very familiar with, ChatGPT and its just ability to come up with, high-level plans, overviews, suggestions, predictions for us. But then I'm also really excited about what we've built at Path, right? We're helping people try to understand, right, where the labor market is going with our career coach that is able to give them just information from, thousands of career advisors, college counselors, even therapists. And then we've also built our skills trainer that teaches people any job skill, whether that be leverage buyout modeling, whether that be plumbing, really any job skill that could help them be able to move up in their current role or transition to a new role.
Is there a sector that you expect could be ripe to experience the next wave of demand boom? And we think about this because it all comes back to where consumers are, where the business-to-business consumers are, where the business-to-consumer, B2C consumers are as well, and where they're putting their money as well. So what is that next area within the broader labor force that could experience a boom in demand as a result of that?
Yeah, I think two things. One is healthcare, right? Healthcare is always just going to be a huge part of our economy. It is an essential. But then I think another place is basically just in the green, clean, renewable energy space, right? Even your last guest, who came on, spoke about it. But with that being said, right, we think about just where the world is going, and there are just some inevitable truths, inevitable things that we need to plan for. And so, as more of these climate related, not just, issues come up, right, but they just become, more in the forefront of our mind, right? Governments and private institutions are going to put more capital into those spaces, which means there's going to be more jobs. And so, again, right, my advice for folks is you don't have to become, a scientist that knows everything about the atmosphere and, CO2, capture or anything like that. But find what you are passionate about within climate. And there are going to be a host of job opportunities, not just technical, not just scientific, but, leveraging your people skills and, some of these other soft skills that you have. Really smart.
Chandler Malone, who is the Path CEO. Chandler, thanks so much for taking the time here with us today on Yahoo Finance.
Thanks so much, Brad.
Absolutely. Hey, everyone, if you're looking to profit from the markets, there's generally two paths that you can go, investing and trading. Which one is the right one for you, and what are some risks that are involved? To help us answer that, we've got Yahoo Finance contributor Ross Mack. Hey, Ross.
My guy, how are you today?
Doing well, doing well. Okay, so what do people need to know about the difference between investing and trading?
Well, you just got to understand that when it's all said and done, right, here are the facts, right? 90% of people that are actually trading, day trading, et cetera, are probably going to lose money. So when it's all said and done, probably the best investment strategy for anyone is to be a long-term investor. And I think there are a few things to actually think about, right? What are the goals? When it comes to investing, well, the goals is to allow your money to appreciate and just wealth accumulation over time. However, when it comes to trading, you're actually trying to profit off short-term market fluctuations. And there are a few strategies that I would recommend if you are trying to trade. But I always give people, the caveat. It's like, listen, sure, you could probably play basketball at your local LA Fitness, right? But when you're actually trying to day trade, guess who you're going up against? The actual professionals. So when you're playing at LA Fitness, oh, you're good over there, but you can't just go to the NBA and play against LeBron James and Steph Curry. So that's the exact same thing when you're trying to day trade. Guess who's on the other side of those trades? The actual LeBron Jameses of the world, because they're on Wall Street and they're managing billions and trillions of dollars.
Yeah, indeed. I mean, you can try and play against them. Probably won't go well, though. What if someone wants to play it a bit safer, though, and invest their money more long-term?
Yeah, the people that are trying to play it a lot safer, I always recommend being a long-term investor, because once again, by purely owning the S&P 500, you're going to do better than 88% of the professionals, 88% of those day traders. And so when you're buying, and when you're thinking long-term, the idea is to buy the best assets that you know and use on a day-to-day basis. And those over time will literally appreciate in value. I look at, my long-term investment portfolio as almost something as saying, you know what, this is just my savings account that is getting me roughly 10% annually. And I think that's how you should think about investing. It is always a great time to start investing and actually think about it from a long-term orientation. My idea is saying, oh, I'm buying this stock, I won't need it, and I won't look at it again for another 5 to 10 years.
All right, Ross, just lastly, you were here with us in New York last week. Now you're back in the Chi, in Chicago, in the land of the Bulls and Bears. That only means one thing. You probably got something big going on this weekend.
Absolutely. Listen, we're doing something monumental in the city of Chicago. We're doing the Maconomics Wealth Summit weekend, where I'm so honored, where we're literally bringing some of the greatest professionals around the world to actually share their own experiences to help the audience have a better relationship with money. That's going to stem from money psychology, budgeting, learning how to invest, just investment 101. We're going to have people that will be talking about real estate, estate planning, tax planning, retirement planning. We're also going to have a networking session where we'll be on we'll be on a yacht party, 400 young professionals, and the dress code will be all white. And then lastly, we're going to have our celebrity basketball game, and that's something that I'm excited about. So all 3 events, Friday, Saturday, and Sunday, will be about networking, service, and obviously, most importantly, education. We are here to transform the relationship with money, and we're going to change some lives.
Ross Mack, very exciting work that you're doing up there in Chicago. Can't wait to hear some of the successes from it. And I saw a lot of good friends of mine and friends of our program on that roster. Absolutely. And we're going to look forward to seeing exactly what everybody is able to take away from it. Ross Mack. And make sure to check out the Financial Freestyle every Monday right here on Yahoo Finance. Ross, thanks so much.
Well, man, we need you in the building. You need to be on stage next year.
Got you covered. Much more on wealth after the break, everyone. You're watching Yahoo Finance. Federal Chair Jerome Powell, Federal Reserve Chair Jerome Powell, of course, is testifying in front of the Senate for his semi-annual monetary policy address. Powell facing questions about banking regulations, housing, and of course, inflation. Here's what he had to say about the central bank's thinking around rate cuts.
We do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%.
Here to help me microscopically comb through some of his commentary, we've got Yahoo Finance's Morning Brief and Catalyst's co-anchor, Shauna Smith. Hey, Shauna.
Hey, Brad. So we just heard Powell talking about inflation. There's some progress that has been made, remaining optimistic about that progress that we really have seen over the last couple of prints. But what stuck out to me in those comments here today, and really what maybe differentiates it from the tone that he has struck in the prior meetings, was he did talk a little bit about the fact that inflation is not the only risk that they face right now. There's also some weakness maybe starting to form within the housing market. He did allay some of those fears, though, saying that, yes, the housing market remains strong, but when you see the numbers, when you see the fact that the employment rate ticking up here over the last couple of months, it does point to the fact that the jobs market has been slowing. So that's really one thing that did stick out to me within his commentary here today. And also just in terms of what this means to you guys at home, he talked about the risk of waiting too long and maybe further weakening the economy. So that really sets up just how difficult this job is for the Fed right now, given the dynamics at play. And I also know a lot of you at home are closely watching what's happening within the housing market. And this is something that's really caught many forecasters, many economists off guard with some of the some of the patterns that we've seen play out within the housing market over the last several months, several quarters. And Montana Senator Jon Tester, he actually asked Fed Chair Jay Powell about some of those housing issues, including low supply and high mortgage rates, and how housing challenges really fit into the Fed's calculus surrounding the economy. Here's what he had to say.
For housing supply, the best thing we can do is get inflation under control so that rates can come back down, so that we can have a more normalized set of rates and a more normalized housing system. But I think policies to increase housing supply are really not so much in the hands of the Fed, they're in the hands of legislatures. I'm aware that housing is in short supply, and that for many, it's a critical need for the workforce. Okay. And so more of it is better, but as to where the fiscal policy how you should prioritize that, that's not up to us.
So as interest rates have remained high for longer, we've seen this ongoing crunch within the housing market. A lot of that being attributed to the fact that mortgage rates still hovering right around 7%. Yes, off of those highs, but not enough to prompt those existing homeowners right now to put their homes on the market. Why? Because if they do move and buy a new home, they're going to be paying higher rates here. Now, it's not likely we will ever return or anytime soon return to those very, very low levels that we saw at the start of the pandemic. But if we do see some improvement when it comes to rates, if we do see a drop within mortgage rates, then the theory there is that is going to unlock some of the supply issues that we have seen play out in the market, and then ultimately potentially make homes more affordable than they are today, and might help, I guess, alleviate some of the pressure that we have seen on pricing.
Yeah, exactly. They said that inflation has eased. It's eased notably over the past couple of years, but remains above the committee's longer run goal of 2%. Total PCE right now, prices still at about 2.6% over the 12 months ending in May. That's the most recent that they were evaluating, and that made its way into the commentary here, broken down by our own Shauna Smith. Shauna, thanks so much.
Thanks for having me.
Definitely. Everyone, that's it for Wealth. I'm Brad Smith. Thanks so much for watching. Stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. You do not want to miss that.